All right, we might get started. Thank you. Good morning. Thanks everyone for coming. Welcome to Houston. Welcome to our final day of our 2023 operational briefing. So today we're doing obviously a deeper dive into the CGM business. So you'll hear from Nick and the rest of the team, which is great. If I could just ask you to put your phones to silent or turn them off before we start. Before I hand to Nick, we'll see a short video outlining some of our staff from CGM and their experiences, and then I'll hand over to Nick. So with that, if we can start the video. Thank you.
We've seen a massive amount of evolution in our business, and it's been so exciting to be a part of a business that's constantly innovating and evolving and being nimble, but most importantly, providing solutions to our clients in a variety of structures, products, regions around the globe. And while we have our global presence, we certainly have regional expertise.
Our competitive advantage is definitely our client base. We service the entire spectrum of the supply chain.
Over the years, we've had to pivot and adapt the business multiple times to respond to ever-changing markets. Today, we're a client-centric business focused on providing funding solutions to a wide range of clients.
We have everything from energy to agriculture to metals, but also niche products like packaging and meats. And those innovative products have allowed us to deliver solutions to clients that they can't find anywhere else.
We can offer our clients access to markets, whether it's capital markets or commodities markets, physical and financial. We can meet with them and come up with solutions that may fit their business specifically. That's really always been our focus. And we're not necessarily just looking at short-term benefit.
We are really close to the clients and helping them and being there daily, really on the long run. We are never about one deal or two deals or about a year. We could spend 1, 2, 3 years without dealing with the client, but they will still be our friends. And when they need something, they will come back. We know that.
I think the culture of collaboration and creativity that's fostered at Macquarie really pushes us to answer the question, what should the clients be doing, rather than what have we been able to do in the past.
We didn't wake up one day to say, hey, we're gonna hedge beef trimmings. It's because our clients have come to us to say, we need a solution for our hamburgers and our hot dogs. What can you do for us? And we took that and ran with it to provide meat hedging solutions to clients today in the Americas.
One of the biggest opportunities that we've identified in our business in the Americas is our ability to provide bespoke interest rate hedge solutions. The reason we have been successful in addressing this structural need is we've been able to collaborate across the broader Macquarie Group with Macquarie Capital to lean on their expertise in underwriting these companies and combine them with our expertise of underwriting derivatives.
I'm also excited about increasing automation in our operations and within our business, and continuing to improve the efficiencies that we have, both of which are key to our continued growth and success.
Thinking ahead for the São Paulo office, I do really see us in the oil and gas market, which we have started recently and we are expanding. And we have closed some deals with very big market players, and we're making a difference there.
There are also going to be opportunities in the renewable space. That's actually been a larger and larger component of the energy story over the past few years, and it's not slowing down. And so Macquarie should be perfectly poised to be very heavily involved in that, and that should be a big part of our focus as well.
Whatever the next big market opportunity might be, I'm confident we can leverage these strong client relationships to have our pulse on the markets and find new ways to add value to our clients.
Good morning, everyone. Thank you, Sam, for that introduction, and everyone. Welcome to Houston. It's so great to be able to host you here. As many of you know, this is the home of our North American energy business, and indeed was my home for 10 years as well. I met my wife here, I had my first kid here, and if nothing else, it made my mum very happy. So this is the third and final day of our American Investors Tour. We started the week in Philadelphia with Ben and the team from Macquarie Asset Management. And that was followed by a full day in New York yesterday where we heard from Michael in the Macquarie Capital business and some of his colleagues as well. So I'm delighted today to be here to talk about CGM's business offering in the region. We established our presence here in the early 90s with a small offering of metals financing out of Denver. And what's followed has been 30 years of growth and innovation. And the Americas is now our largest contributing region, representing almost 40% of our total income in CGM. Our Houston office, which you'll see later today, represents our global energy headquarters and has over 500 staff across the group. So we're really pleased that you could join us today, and once again, a huge welcome. So the last time I presented CGM as a group was at our Feb 2020 operational briefing. And since then, CGM has continued to evolve and grow, and we continue to see more opportunities emerge today. As we scale the business, we appreciate that understanding CGM has become more important, and explaining what drives our growth is important for all of you and important for us. Our business is diversified and it's client-driven. And as we grow, that diversity only continues to expand. And as we get bigger, the solutions we're providing to clients often involve combining a number of these building blocks and bringing them together. It's connecting this diverse offering that is often a differentiator for us in CGM, and I want to tell you a story about how this all hangs together. As many of you would know, we have a mobile phone leasing business, and for a while it was really quite successful. We started the business off in Europe and eventually brought that offering back to Australia. But as happens sometimes in vanilla businesses, as the market became to understand the leasing product a little bit more, we were eventually priced out of that business on a return on capital basis. So normally you'd expect that to be the end of the story, but not so in this case. Back in Europe, we were still staying really close to our clients in the sector. And one day, one of those clients came to us with a problem, and it was something that no one else could solve for them. They had a capital problem, and it was associated with them rolling out their brand new fibre network. The case for rolling out the fibre network by itself was compelling. It was 7 times more energy efficient for the telco, it was of superior quality, and it was faster. But the problem was, it was extremely capital intensive, because in rolling out the new network, they had to also dig up the old copper, which was still in the ground. And that was an expensive proposition. So what they were looking for was someone to pay for that copper whilst it was still in the ground and before it was available to use, so they could then use that capital to finance the entire rollout of the program. So our team worked out that we were able to provide the capital that the client needed by buying that copper today, leasing it back to them, and eventually taking physical delivery of that copper when it was dug out of the ground. But the challenge was determining the value of that copper in the future when it was delivered, and thereby protecting the capital that was deployed in rolling out the network in the first place. And this was part of the problem that no other European bank was able to solve. So our leasing team reached out to our copper desk to try and come up with a solution. The traders on our copper desk were able to guarantee a price for copper for when it would be ultimately delivered in the future. So this outcome resulted in a unique product, a combination of an operating lease coupled with a forward purchase of a physical commodity. The problem was solved and the capital was deployed. This solution has allowed us to roll out over $1 billion of financing in copper to the client to date. The customer received the financing they need to get their network rolled out, and they were also able to book profits on an asset that they'd previously written down years ago. So a fantastic solution for the client, and an idea that is now really scalable for Macquarie. And because it's a leasing product, it provides our business in CGM with valuable annuity income. Now, if you take a step back and think about the product in its complete form, you might say that it's highly structured and somewhat complex. But actually, in truth, when you break down the core components of the product, it's really just the combination of 2 simple activities that we provide every day: a leasing product and a hedging product. And this is something that we've been doing for a really long time. And it's this analogy that comes to mind when I think about CGM, because much of what we can do can be explained very simply when we break it down into its diverse offering of its individual parts. So what is it that CGM does, and how do we explain it? In its most simple form, CGM has 3 business lines: commodities, financial markets, and asset finance. And across those business lines, we broadly do 4 things. The first thing is risk management. This is where we provide our derivatives or hedging service, and where we help our clients manage exposure to changes in prices in markets. So an example of this would be a producer who might know how many barrels of oil they're going to produce in the next year, but don't know what price they'll receive for it. So we'll engage with them and exchange a series of fixed cash flows for floating cash flows. The second business is our capital and financing line. This is our lending business. This is where we provide clients with financing solutions across the capital structure. So an example of this could be a working capital facility for a corporate that's backed by a line of receivables. The third activity is our market access business line, and this is where we help our clients access markets globally. So for example, in our futures business, we help clients access markets that are traded on an exchange. Here we act as an agent rather than as a principal. And finally, we have our physical execution and logistics business. And this is where we trade commodities physically. And in essence, what we're trying to do here is take commodities from where they're produced to where they're consumed as efficiently as we can. Now, in all of these underlying activities, we're obviously left with some residual risk, and we look to optimise that risk as we manage through our business. But we'll also take principal positions where we have strong conviction to do so. And of course, all of this activity is undertaken under the strong internal Macquarie risk management framework that's been developed over the last 30 years. So, who are we? Well, we're a global network of 2,300 specialist staff, and we provide access to markets 24 hours a day, and in some cases, 7 days a week. The team comes with a diverse range of skills and technical expertise, including logistics, geology, meteorology, engineering, trading, and scheduling. The team has been together for a very long time. And as with most of Macquarie's businesses, our tenure is long, with our most senior level, our senior managing directors, having an average tenure of 17 years. And this is something that we believe is an important feature of how we collaborate as a team, our diverse skill sets, and how we come together to solve clients' needs. Fundamentally, our business is a client-led business, and we've been partnering with our clients for over 40 years. Our relationships are built on strong collaboration, and pleasingly, 85% of our client-related revenues come from existing relationships, which is something we believe represents the quality of the franchise. Last time we met, we said we were going to continue focusing on our core client business and expanding into adjacencies. That's always been our approach and will continue to be going forward. Since then, you can see that this is what we have done, growing in adjacent business lines in a patient and accretive way. So I'd like to draw out 2 specific examples. Firstly, in our FIC business, we've continued to expand our sponsor coverage in both our interest rate derivatives and our FX structured product offering. Something we heard Tom talk about yesterday, and something Glenn will expand on later this morning. So in addition to that, the FIC team has rolled out our Aurora E platform, opening up new markets and clients for us. These 2 developments, among other things, have really helped drive the significant earnings growth across our financial markets business in the last couple of years. Secondly, like our colleagues in MAM and MacCap, CGM has a strong focus on supporting clients through the energy transition. Now, this, of course, is not something new for CGM, as we've been active in renewables for quite some time, but we continue to expand into new areas like critical minerals, the circular economy, and clean fuels, something we'll hear a lot more about from Janet later on. It's only natural that we have a large role to play in the energy transition, as it's often our clients are the ones who have the largest carbon footprint and need the most help to transition. And as I've mentioned before, and will again, our business benefits from a considerable diversity both by region and by business line. The Americas is our strongest region, but we have a growing presence in Europe and across Australia and Asia. And whilst we do have three main divisions, commodities, financial markets, and asset finance, you can see clearly here there are a large number of underlying business lines that underpin those divisions, which give us diversity and often have low correlation with each other. In our commodities division alone, we have 11 separate business lines. And it's this diversification effect, combined with a strong client franchise, that gives us confidence in the consistency of earnings across CGM. Different asset classes will do well at different times. And ultimately, over the long run, it's this diversity that provides a level of certainty to our earnings base. We believe this is core to the value of our franchise. Pleasingly, it's this diversity that's played out in the group's recent performance. This slide highlights the strength of the client franchise and the quality of the underlying earnings. The various shades of green represent all of the different ways we are deriving income from our client base. On top of this, you can see our additional non-client related trading revenue, which we believe represents the optionality aspect of our earnings. This includes our physical inventory management and trading income. There are two things I'd like you to take away from this. First, that the trading revenue tends to increase as the underlying client activity levels increase. And secondly, we tend to set up our trading risk as a series of asymmetric options, which we'll talk more about later in Tim's presentation. Now, risk is fundamentally core to everything that we do. Our job revolves around the taking of risk and the managing of risk. And it's how we manage this risk that directly impacts our performance. We get a scorecard at the end of each day, which tells us how we're doing. Our approach to risk has remained unchanged, underpinned by the core principles of Macquarie's risk management framework that have been in place for over 30 years. And it is supported by a really strong risk culture. Firstly, the business owns the risk. Secondly, we're always focusing on the worst outcome, and then we'll size our risk appetite to what an individual business can afford. And finally, all of the risk is independently signed off by a central risk function. This is really important because the function is responsible for both reviewing and challenging the business, and that results in better risk outcomes for the group. The risks that we face across the business include both financial and non-financial, and both of which are equally as important as each other. On this slide, you can see a breakdown of the capital we hold against the CGM business. And as is consistent with the client-led business, credit continues to be the largest component of our capital makeup. You can see here now we're also holding slightly more market risk capital, as we've recently seen trading opportunities as a result of volatility. This step up, though, is in line with the growth of the underlying franchise. On the right-hand side, we've updated the group daily trading P&L histogram to reflect the third quarter and year-to-date trading conditions. There's probably a few observations worth calling out here. Firstly, the shape of the curve does look slightly different than it has in the previous years, and this reflects the increased client activity and trading opportunities we've seen in the period. And secondly, whilst the skew remains the same, we have more daily trading gains than losses, and this reflects, again, the strong client franchise, but also, importantly, the asymmetric nature of the majority of our trading risk. So turning now to the Americas, and as I mentioned earlier, it's the largest contributing region from a P&L perspective for CGM. We are active across all of our major business lines, with the strongest contribution coming from commodities, then financial markets, and a relatively smaller contribution coming from asset finance as the team continues to focus in other regions. Across CGM, we have over 630 staff, and our global energy hub is headquartered here in Houston. But in addition, the growth in our FIC business in New York has seen the Americas become the strongest contributor for our global FIC platform, something that Glenn will also talk about in his presentation shortly. But overall, a really strong presence in the region for CGM, and there are ample opportunities for us to continue to grow. The presence that we have today has been a result of a long history of evolution. And as I mentioned earlier, we've been in the Americas for 30 years. Our platform today is a result of patient, adjacent growth with some key acquisitions along the way. Now, a number of these acquisitions are highlighted here in the slide in light green, but we've also had considerable organic growth in dark green. But what you don't see here in the chart is how the leverage that comes from a successful acquisition. And a good example of that is the most recent acquisition of our Cargill Gas and Power business. So when we acquired Cargill's Gas and Power business back in 2017, we had a pretty good understanding of what would come with the acquisition. But perhaps what we underestimated even back then was just the sheer size of the opportunity that still was present for us in North America, just given the size of the market. So we already knew that we had great coverage prior to the acquisition across the gas and power markets. But by adding just 35 people, we were able to add hundreds of millions of dollars to CGM's revenue line each year. So when we think about the growth opportunities that lie ahead for CGM in the Americas, I often reflect on what we learnt from this acquisition. Firstly, the significant adjacencies still exist, even for the businesses where we have scale. Secondly, when we get the cultural fit right, staff that come with the acquisition generally do well. It's the environment that empowers them, but it's also the benefit of having a strong risk management framework. And finally, the North American market is so large and so deep that even where we have scale in some of the areas that we operate, there is always a long runway for continued growth. And this is something you can see here in terms of some of our activity levels and the relative sizes of the markets that we operate in. So again, notwithstanding the scale, in the broader context of the market, still a lot of opportunity for us to grow. So in summary, we remain very optimistic of the opportunities that we see here in the Americas as we continue the journey of adjacent expansion, but also exploring new opportunities as they emerge. So I've got a number of my colleagues here today who you'll hear from that are going to talk about those opportunities and talk about where we see growth into the future. So firstly, we've got Tim Bourne, who's the co-head of North American Gas, Power and Emissions, and also the global head of LNG. He'll be followed by Dan Vizel and David Hochberg, who lead our agricultural and oil businesses globally. Janet Dietrich and Macquarie Capital's Nicholas Goll will talk about our role in the energy transition. And finally, Glenn Edelson will talk to us about the expansion we've seen recently across the Americas fixed income and currencies business. So with that, now I'd like to hand over to Tim. Thank you.
All right. Thank you, Nick. Good morning and welcome to Texas. I'm Tim Bourne. I'll be presenting today. Cindy Keck is joining me. She presented to some of you in 2020, so I guess it's my turn today. She's here today and available for questions later. I'll start with Nick's CGM overview. We operate in the bottom half of the chart. So our business starts with a wide array of financial and physical products that we provide to clients. We overlay that with, okay, what was on there? Okay. We overlay that with an extensive logistical model that we've strategically built over decades. This includes natural gas transmission or transportation, storage, and power transmission. And then we optimize and we trade. The success of our franchise is a reflection of the quality of our people. It's a blend of specialists that you can see on the right side of the page. The hallmark of our business is a tremendous stability as a team. Our executive directors average over 19 years of tenure, and our retention rate is very, very high. This continuity is something that we believe sets us apart from competitors. We built our business patiently through a number of key hires, 3 significant acquisitions, and key organic growth. In 2005, the business was started with the acquisition of Cook Inlet. Cindy was part of that team. Cook Inlet, based in Los Angeles, had a very strong West Coast franchise. It also was active in the Mid-Continent, Texas, and the East Coast. A year later, we entered the power market in 2006 with a number of key hires. This allowed us to quickly enter the actively traded power markets in the U.S. Then a few years later, the Constellation's gas business was acquired. I joined at that point along with 100 others. We then merged all of the businesses in Houston and quickly became one of the largest marketers in North America. We also became active in Canada with a small office in Calgary, and at that point we became active in LNG. In 2017, we had the opportunity to acquire Cargill's gas and power businesses. This gave us the ability to significantly strengthen our power franchise and also reshape our Canadian footprint. 35 people came on board, and we kept an office in Minneapolis. So a few key points throughout this period. Our acquisitions went extremely well. We only acquired businesses that we felt were a good cultural fit to Macquarie. As Nick pointed out, with these different acquisitions, they thrived in Macquarie's culture. Today, all of our books are strong and integrated. And importantly, people stuck with the program. As I said earlier, our business starts with a client. This is a view of the different things we do with our clients across North America. Our client activity is very diverse. We do the basic stuff like hedging for producers, index sales to consumers, but we also do specialized products to our clients, things like responsibly sourced gas, RSG. So this is natural gas that is third-party audited that adheres to certain environmental standards. Jen in our COO group has a video at the break, and then Janet will talk about it later and highlight it. And by the end of the morning, you'll know a lot about RSG. We also provide services that balance loads for utilities. We do asset management deals with utilities where we manage their transportation and storage and optimize it, and then we share in the gains. We even acquire transportation for clients that allows producers to move gas in constrained areas to market. We also have a complex, this is the complex North American natural gas grid. Highlighted in the blue are pipelines that we transported in the past year. We transported on 69% of the pipelines in December. Over the course of the year, we do many more. And if we don't transport, we'll trade on those other pipes. We also are very active on the larger intrastate pipelines. We have contracts for a significant amount of storage and storage lookalike products. Our peak day last year was 11 BCF per day. To put that in perspective, the average load in Australia is 4.1 BCF per day. So that's a lot of gas. Importantly, our transportation and storage portfolios give us access to most parts of North America. We have an equally strong power logistic capability. We're active in all parts of the power grid, including Eastern and Western Canada. Our teams, and we have under contract a little over 1,900 megawatts per hour of seasonal and yearly transmission. Our team are experts at understanding the infrastructure of the grid that allows them to identify paths that are available and will flow. So a perfect example is during Storm Uri 2 years ago. So, and I'm going to move over this way. So we were able to, during the storm, acquire incremental transmission from PJM to MISO, incremental transmission from MISO to SWPP, and then we used existing capacity to move from SWPP to ERCOT. So basically, we were able to move physical power from the east, where the weather was mild, to Texas, where it was needed most. So our base portfolio with client business and logistics, we optimize and we trade. We always trade on fundamentals. It's almost always in the form of spreads, spark spreads, logistical spreads, or time spreads. We're almost always long optionality. As you'll see on the tour today of the floor, we have an extensive and very strong risk management and compliance culture. Where most of the industry operates under a simple VAR model, we operate on a daily basis over 6,000 stress cases that have limits associated with it. And we even have a stress limit for worst case scenario. And lastly, and importantly, we always look for asymmetric risk. We're almost always on the tail. So why? So our basic model of client business, logistics, optimization, and trading, it's delivered over the years. But what we're seeing lately and increasingly is more volatility in gas and power. It's due to a number of reasons, and so it's largely around a combination of 4 areas. Infrastructure issues, energy transition, weather, and the globalization of natural gas. So starting with natural gas, there's a lot of points on this slide, but I want to point out natural gas is the transition fuel and will be for decades. In the past 10 years, natural gas production has increased dramatically, and it's increasing. Power generation in North America from gas has increased 14 BCF per day. That's kind of holding steady. Exports to Mexico and LNG exports have increased an amazing 900%, and that's growing dramatically. But we've lost 69 BCF of working gas storage capacity. That's down 2% over the last decade. Storage is critical to our model to balance winter and summer demand. It's also, 2 minutes ago, the government report came out, so we have a weekly report on inventory levels, which moves the market sometimes with big misses, so we'll see how that's shaped up today. But if you look on the bottom chart, we consume much more gas in the winter than the summer, but our production profile is fairly stable. So we need this to balance on a seasonal basis and a daily basis. So losing, and then in the lower right, you can see how production demand's going up, storage going down. That's a big issue because there's fewer and fewer tools to manage this type of load differential. Adding to the volatility, we have an aging pipeline system. Our interstate pipeline system averages 50 years. Things break. Also, with the urgency of the transition to transition to renewables, very little natural gas infrastructure is getting built. You can see on the right, upper right, that's number of miles in each decade. And then you can see on the pipeline map, in the past 10 years, 3 interstates in Texas, 1 Louisiana pipeline, 1 Oklahoma pipeline, and 2 interstate pipelines through the Marcellus have been built. Now there have been, compressor, programs. There's been looping and everything, but this is the major pipeline, and this is a problem. It's very difficult to get a pipeline approved and built. That causes volatility. And then finally, we estimate that up to 43% of the natural gas is associated gas. That means the crude oil is the primary product, natural gas is a secondary product. So that's why we see from time to time natural gas prices can go negative and deeply negative in certain areas if the crude oil economics support maintaining the crude production. Power also has a number of reasons for sustained volatility. As with gas infrastructure, the power infrastructure is aging. The age of the natural gas fleet is 23 years of service. Coal and nuclear are older, and in some cases approaching end of life. Our wires are getting old, so the transmission lines are getting old. Things break. Generally, coal, nuclear, and natural gas plants are not getting built. Solar and wind are. The chart on the lower right, the 2 pie charts show you in 10 years that natural gas has gained a lot of the share It's the biggest part of the share, but you can also see that wind and solar are replacing coal. Fantastic for the environment, but we're not at a point yet that batteries can replace the steady production profile of natural gas, coal, and nuclear. So significant volatility happens in the daily and hourly power markets, and that's growing. We spend a lot of time analyzing weather. We have 2 meteorologists on staff and another number of vendors that provide information. With our logistics capability, moving power and gas around the North America, what we depend on is weather variability. On this slide are the last 8 years of peak winter, so December through February. If you can see at the top, we've managed through some of the warmest winters on record, and we've done very well during those winters. So we don't necessarily need a very cold winter or a very hot summer. What we need is variability between the regions. And this past winter is a perfect example. Very cold in the West, and we're still seeing very cold events with snow in Orange County, but a very warm East Coast. We're also seeing natural gas become more global over time. 5 years ago, when we do our analysis each day, prices in Asia and Europe really didn't matter. Jump ahead 5 years, now the U.S. is the largest exporter of LNG in the world, and that is growing because projects are seeking out the cheap U.S. natural gas production. Plants go down, and they go down often. They may go down for fog, they go down a lot for maintenance, and that has a big impact on the volatility in the region. Most of the facilities are in the Gulf Coast. Our benchmark price, Henry Hub, is in the Gulf Coast. Interestingly, in the Northeast, we still import LNG, so we compete with the world to get gas in the Northeast because pipelines can't get built. So largely, prices are a function of TTF or for European prices. So global prices matter, world events matter a lot. So what's next? Again, natural gas is a transition fuel. Our core model is sustainable, has many avenues to grow, and we will see growing volatility over the next decade. We have tremendous opportunity to grow our LNG franchise. We're one of the few companies that can add value to every component of the LNG value chain, especially when CGM, MatCap, and MAM work together. We have very strong teams. Besides the North American operation, we have very strong teams in EMEA, Australia, and Asia, and we're perfectly situated for a more global natural gas future. And finally, we're very excited about the new products and services that will evolve as we help our clients navigate the energy transition. So thank you, and I'll turn it over to Dan Vizel and David Hochberg.
Thanks very much, Tim. Hi, everyone. I'm Daniel Vizel. I've been with Macquarie for over 25 years. A bit over 10 of those years were here in Houston running the agriculture and oil business, and in July I moved to Singapore to head CGM Asia. I'm going to tell you a bit about the history of agriculture and oil and the evolution of the businesses here at Macquarie, and then David Hochberg's going to come up and tell you a bit, give you some case studies, and tell you a bit about our future outlook for the business. So what do we do? At its core, we're a risk management business. We offer price risk management for our clients, mainly via derivatives. And we're hedging not just the costs for them, the inputs, the feedstocks, for example, jet fuel for an airline, but we're also hedging the output. So the crude oil for a producer, or if you think about a sugar grower, the production of the sugar, where that could also be a feedstock for a drinks company, for example. And we're doing most of that via derivatives. We offer capital and financing. Most of that's done via short-term working capital facilities for our clients, which involve quite often owning inventory and storage and selling it just in time to them, or owning it in transport and getting the product from one location to another for them or for their clients and delivering it to them. And of course, we have our physical execution and logistics business, which isn't just a service and a product on its own. It's actually a tool and an enabler for us to offer products in the other areas. For example, in capital and financing, we're able to use our physical execution logistics to secure the product that we're financing for our client and to control its movement and make sure that we know where our underlying security, or if you call it security for a loan, is at any point in time. And for the risk management, we're able to offer fixed price or embed derivatives effectively into physical contracts for clients that prefer a physical deal as opposed to a derivative contract. And all of this is around our clients, which are the center of everything we do. We're trying to create bespoke solutions for our clients to give them the best risk management tool that they could get. And below that, we're doing our optimization and trading. And when I talk about optimization in our business, I'm sort of talking about going to liquidity. Effectively, we offer our client a bespoke solution that gives them the best possible risk management that they can get, and we charge obviously a risk premium for that, and we hedge that risk by going to, for example, a Brent futures contract, which is very liquid and very cheap for us to hedge with. And we add all these basis risks for all of the deals that we do with our clients. We try and retain as much of that risk premium that we charge for those deals within Macquarie by managing our exposure with the cheap to hedge products. So how do we do it? We have deep expertise in these physical and financial markets. We've got over 175 people focused in this space around the world. And our team of executive directors have been there a very long time, more than 16 years, and our retention rate is also very high. And we've got a diverse range of people that help us perform. Logistics experts that are arranging or negotiating charter parties with shipping companies or helping us with negotiating pipeline contracts. Our schedulers that are making sure that the product is where it's meant to be and arranging for the strict vetting policies that we have to check on our suppliers, make sure, or on our service providers, make sure that they're keeping up to the high standards that we require. They're also performing inspections on the products themselves, making sure they are where they are, making sure it is what it is and that the quality and quantities are all correct. And we do that not just on a regular basis, but ad hoc as well. And we're also checking on those terminals, making sure they're performing at the standards that we require. Our operations team that help us get those deals into the system, help us manage those risks, make sure all the downstream reporting's working and we're capturing all of the risks associated with these transactions. And of course, our analysts, we've got Rick Deverell here as well, I didn't know he was coming, but our analysts are there, not just macro, thinking about the macro world and economies, but micro. We're looking at vessel movements, understanding supply and demand balance sheets, and looking at balances, but actually more importantly, imbalances in the world of commodities and understanding where those imbalances are and how we can best manage our risk and our exposure around that. But also importantly, we're providing that information to our marketers, who are then going out and talking to our clients and helping them manage their risks. And those marketers, they're just not salespeople. A lot of these people are industry experts. They're able to have really deep and meaningful conversations with the clients about risk, and they understand it. And then finally, our traders, of course, managing all of those exposures within our portfolio and within the market, within the risk framework within Macquarie. And some of those traders are actually product specialists as well, understanding the basis risk exceptionally well, so we're able to be ahead of where the rest of the market might be on some things. And we continue to evolve, and you can see here our growth. This is a chart of our net income for agriculture and oil businesses over the years. The agriculture business is a lot older than the oil businesses, but this is where we were able to show meaningful data. And you can see here, there's not just one thing that made us successful, it's everything. It's this constant growth into new products, new services, new clients, new regions, and that constant accumulation of all of this growth into adjacencies that's made us successful. And as you can see there, we continue to grow. And as we grow, we get different clients are the number one client every year. They always remain clients. We hopefully have them for a long time, but it's not always the same place that is the thing that is making us successful in any one year. And that diversity is one of the reasons we're really bullish about our growth for the future, that we'll continue going up in that direction. So we offer a diverse range of products, and we continue to evolve. And in this evolution, we've brought together our oil and agriculture businesses. We've seen the opportunity here where agricultural products, some of them have become feedstocks for the oil industry to make renewable fuels and clean fuels. And that's meant that the price of these products is now somewhat derived from oil. So we want to be able to offer a homogeneous, holistic solution to our clients where they're able to manage all of their exposures with the same kind of products. So agricultural companies, we're now exposing them to oil products and the types of deals we do in oil, and vice versa. Our oil clients are learning about agriculture and learning how to manage risk in that world. And we keep growing that client base, and bringing it together has given us great opportunity to cross-sell and to really help our clients with their risk. Because it all starts with our clients, because we are a client-focused business. And although the headline here is very impressive that we've grown 150% since FY17 in a number of clients, actually, the story is far more amazing than that. When you think back to when Nick was part of starting the business in 2003, so 20 years we've been in energy. Being an Australian bank, we probably just had one client when we first started, and it would have been an Australian airline called Qantas. And they probably would have hedged jet fuel with us. And they would have done a jet swap, and we would have been short, and we then would have gone out to find a producing client and an oil producer and gone out, get them to hedge their production, and they would have sold us Brent. We're left with jet versus Brent, which we call crack, but it's a margin for refiners. And we go out and find a refinery that's looking to hedge their margins and lock in their returns, and therefore taking out all that risk. And that growth step by step from product to product, client to client, and region to region, we continue to see. And to the point where we're at now, where we're growing into multiple sectors, and people don't necessarily appreciate how important a component the transport and energy cost is in the fuel in the product that you buy in the grocery store, and the packaging as well, which is a key part of the cost of products at the end of the day. So we continue to grow, and you can see here the dots on the map where we have a concentration of clients, which we cover most of the globe, but actually we're still bullish that there's a lot of open space there, and we can continue to grow into new areas and build on the existing places and add new sectors and new clients to all of the areas that we're touching. So we're looking forward to continuing to expand. And with that, I'll hand over to David.
Thank you. All right. Good morning, everyone. I'm David Hochberg. I first joined Macquarie via Cook Inlet in Los Angeles in our natural gas business. Spent the entirety of my career in the commodities markets, and more recently moving into the global oil markets about 5 years ago. Dan highlighted our growth story and how our team's been built. It's something that we're quite proud of. What enables all that is a robust risk framework, and risk management is core to what we do. Every transaction that we have has some form of credit risk or market risk. Our legal and risk team feels like they're part of our deal team. Compliance is someone that we talk to regularly. Operational risk is something that Dan highlighted, and our processes, which are robust, that we have around that, and our team that manages it, are key to enable our physical business and our financial business. And of course, ESR risk, where we ask ourselves, not only can we do this as we're looking to grow, but should we do this? We have a fun case study here. We've talked about our growing platform, and Dan highlighted the investments that we've made to have a full financial and physical offering for the market. Why do we want to do that? I think this highlights it. This is an opportunity that came to us through our London-based business, actually. We had a salesperson meeting with a client that was articulating our growth story in the US and our capabilities. Out of that conversation came an opportunity. We realized that that client was looking to make an investment in the upstream sector. So we were able to do something which was pretty unique. Now, we've talked about complexity in our business, and I think an analogy that we've been using recently that's kind of fun is, it's like my kids that want to go build a Hogwarts castle out of Legos. It looks pretty complicated, but at its core, it's actually a combination of simple blocks. That's what our business is. Complex solutions that, when drilled down, are quite simple, actually. So this opportunity It started with financing, our financing block. We were able to provide a loan to that client. The second part of it is our physical execution and logistics platform, where we're able to, in the form of a repayment, take that physical oil from the client, move it through our logistical network, and ultimately to refining clients in the US Gulf Coast. Lastly, we can provide risk management for the client, derivative hedging so that they can manage their price exposure. Those things together for us and for the client actually end up being a really good solution. If they look at each of those solutions independently, they might be more expensive. For us, we're able to provide them a holistic solution because it helps us as we optimize our network. So it's good for Macquarie, great for our client. We see significant changes ahead in the market, and it's something that we think that we're well placed to grow and thrive in. We've talked about our analysts earlier. We talked about Rick in the back row. Supply and demand and geopolitics have been the major factors that have driven volatility and correlation in our markets. That analytics to evaluate those are key and core to what we do, where we think that we have some of the best people. They're a core part of our team. So as we look ahead, we see some significant changes. Due to energy transition, we see demand for both gasoline and diesel declining as we move towards electrification. We also see a decline in diesel as we have substitution for renewable diesel. Alongside of that, marine fuels have actually been going on a journey for at least 3 years now, where we had the sulfur content was part of something called IMO 2020, where we lowered the sulfur content in marine bunkers from 3% to 0.5%. That caused significant changes in the market. The market adapted. Since then, we've seen an appetite for clean fuels, as we've seen shipping companies put out orders for LNG vessels, and more recently for methanol vessels, where we are forecasting, I think it's greater than 80 vessels will be on the water that are going to be methanol powered within a few years. It's a pretty big change. Alongside that, interesting statistic that actually came from someone on Rick's team. I'll quit calling you out here now. But apparently only 20% of the world's population has been on an airplane. There's significant demand opportunity in front of us there. Naphtha and LPG are two more commodities that we see that have growing demand. And of course, we just mentioned methanol. So what does this all mean? Well, it means significant changes to the refining slate. As the demand for a refinery's output is changing and evolving, refineries need to adapt to that. It's going to create significant need for capital investments. It's also changing the types of crudes that the refineries are looking for as well. We also see the need for an investment in logistics systems as we look ahead. These changes likely are going to combine to create more volatility and less correlations in the market. So in addition to the fundamentals changing, we also see the landscape changing. One example of that is the participants in the market, where we've seen integrated refining and upstream companies that have been divesting assets. Those assets are being divested to smaller independent companies. Those companies that we think that we're well placed to serve for both financing, risk management, and logistics. 3 things that we can offer them. Dan mentioned earlier our decision to bring our oil and our ags businesses together. We think that, combined with our strong team of analysts, traders, marketers, schedulers, and operations, are all going to lead to our unique ability to provide clients with access to the expertise to manage both traditional and renewable fuels needs. This is an exciting case study for us in that it highlights some of the exciting opportunities that we're seeing, particularly in the clean fuel space. It's also an excellent example of how we leverage existing businesses to grow into adjacencies. This opportunity came up as from our natural gas business as we were talking to a client about a long-term natural gas supply deal. That conversation evolved into talking about methanol marketing and trading. Our oil team was ultimately able to schedule. They were able to put together an opportunity for them that actually allows us to source the natural gas, move that on pipelines to their facility, where it's converted into methanol. We then use our vessel team to source vessels, and then our global trading team moves that product to our global clients. So, fantastic solution for the customer. What we're excited about this is that it's highly scalable. Having worked through the solution, we're already seeing the opportunity in the pipeline for more deals. It's examples like this where we're innovating in an agile way across areas that give us confidence in the growth and through the opportunities for our business. We're now going to take a 10-minute break, and then Nicholas Gohl and Janet Dietrich are going to talk to us about energy transition.
Ridiculous. Hi, everyone. Hi, welcome back. So we're going to start with a short video, as David mentioned, and then we'll hear from Janet and Nick on energy transition. So if we can play the video, thanks very much.
Commodities and Global Markets has been facilitating solutions for our clients to help meet their net zero and broader sustainability goals. As part of our approach within our existing client base, we've seen an increase in demand for and supply of responsibly sourced gas. Responsibly sourced gas, known as RSG, is essentially natural gas produced by companies whose operations have been independently verified as meeting certain environmental, social, and governance standards. This is a very rigorous process to achieve this certification, with producers taking a number of extra steps in the process, which includes mitigating, monitoring, measuring their emissions, tracking and reducing operational stress on local water, resources, and limiting the effects of the operation on the local land and community. Pacific Cambrian Energy is a leading natural gas exploration and production company in Western Canada. Énergir is Quebec's leading natural gas distributor. Macquarie led a syndicate of these top energy market participants to facilitate basically the purchase and sale, transportation, and delivery of RSG. Macquarie also arranged the delivery and retirement of the associated RSG. These RSG certificates are held with Expansive, and that's what makes this transaction so special, is use of a digital registry. This digital registry issues, tracks, and retires the certificate using a distributed ledger technology. The use of the digital registry raises transparency standards across the entire value chain of gas procurement transactions. It essentially creates auditable digital assets that establish a record of gas origin, independent third-party greenhouse gas certification, verification, reporting, and retirement. Almost simultaneously, Énergir had committed to sourcing 100% of their gas supply as RSG by 2030. And at the same time, Pacific Cambrian became certified for their sustainability practices and achieved their RSG certification. Both of these companies were already existing clients of ours, and we were able to leverage our strong relationships with both of them to link up Pacific Cambrian's supply of the RSG and Énergir's demand for the RSG. This was the first known transaction of its kind, but it definitely was not the last. Our relationship with Cambrian in particular has continued to grow, and we have since executed multiple RSG transactions with them. This transaction has also opened up opportunities to expand our RSG offerings to other clients. We're able to support clients by merging our expertise in traditional energy with energy transition and decarbonization strategies. In addition to our client-driven approach, we also have a deep understanding of the energy sector and strong relationships across the industry, from suppliers to registries to distributors, which allows us to scale with creative solutions. We are unique in that Commodities and Global Markets is involved in a lot of physical transactions, but we also bring together a few different areas of expertise from across the group and can combine strengths from the carbon team to the financing division to the commodities group to deliver for our clients.
All right, good morning. We hope you enjoyed this video from our Calgary-based client team and seeing a little bit more about what they're doing in North America to help support our clients in the oil and gas sector and on the path to a lower carbon future. And I think, Tim, as you mentioned earlier, I doubt you realized how much you were going to get to know about responsibly sourced gas in sitting here today. My name's Janet Dietrich. I'm a Senior Managing Director in our Commodities and Global Markets group. I've been here with Macquarie for about 12 years now. Up until 2 years ago, I was focused on helping to lead our Americas client franchise around our energy business. And about 2 years ago, I stepped into the role that I'm in today, which is helping to lead our energy transition strategies across all of our businesses in our regions across the world for CGM. I'm joined today by Nicholas Gohl, Nick and I, from Macquarie Capital, Nick and I are going to take you through a few things. We're going to touch on the role that Macquarie is playing in the energy transition. We're also going to talk a little bit about our whole house approach to the energy transition, and then we will go into how both CGM and Macquarie Capital is positioned as far as the growth and the opportunities that we see that the transition is bringing us. So Macquarie is committed to playing a leading role in driving the global transition. We've been doing this for over 2 decades, and we're using our deep capabilities in energy, in infrastructure, in technology, and commodity to create real practical solutions for our clients. And we're continuing to work to build on that. Climate solutions are being driven from inside all of our businesses. Adapting with our clients' needs is at the core of our business, and moving into adjacencies from our existing businesses is how we have historically grown, and it will be how we continue to grow in the future. Given all our capabilities and market insights, we do believe we're well placed to support our clients as they navigate the broader energy transition. So it's also important to realize that the energy transition is impacting all of our clients. It's across all of our sectors that we already have broad coverage in and deep relationships with. And it's not just the energy companies. It's companies in transportation, in agriculture, in our metals businesses, in manufacturing, all the diversified industrials, and so on and so forth. The technology solutions that are being leveraged vary for each client and each sector. And given the broad expertise that we have in CGM, in Macquarie Capital, and also in MAM, we can tap into that expertise to be sure that we're really bringing that together for our clients as we see opportunities to convert on. So in terms of bringing the whole of Macquarie, one really good example of this is the Climate Solutions Task Force that we actually started a little over 5 years ago. This task force brings together senior leaders from across the group to share experiences, to stay informed, to discuss opportunities in our various markets, and also and especially to drive action. Both Nick and I sit on the task force. We also sit on one of our important subcommittees, which is the technology subcommittee. And basically what we're doing there is really helping to bring that real world expertise across all of these technologies and throughout our different business groups around the world. The energy transition is a large, accelerating, and a very long-term opportunity. If you look at the chart up on the left-hand side, the top left, in 2020, investment exceeded $1 trillion. That's up over 30% from the prior year. And very importantly, this is the first time that this has been measured in trillions. And the industry estimates multiples of this investment level will be required going forward to get on track for net zero. The vast majority of countries have committed to net zero targets, and corporates also committing to net zero targets have continued to accelerate. This is especially evidenced by the recent legislation in the U.S., the Inflation Reduction Act. And I know that you've been taken through a lot of detail around this the last 2 days, but it's a very, very significant piece of legislation for us. But it's followed on by other jurisdictions, like in Europe with the Green Deal industrial plan that was recently passed. So basically, significant opportunities with our existing clients, also with new clients, to bring our cross-group expertise, capabilities, and balance sheet to the fore. Okay, so what are we doing in CGM? The energy transition has impact across all businesses. It's relevant across all of our markets and to all of our clients. It's a continuation of a strategy of growth through adjacencies. We believe transition is just that. It's a transition. It's not a switch. We believe in conventional energy sources. We believe for a very long time, and we will continue to work with our clients to navigate the volatility and help them in the things that they're doing to decarbonize their businesses. So we wanted to show you a little bit about our emerging opportunities that we see, and they are really in the following 7 sectors that we've got listed here. And what's important to draw out on this slide is that these opportunities are adjacent to the existing businesses that we're in and that we're in today. When I started this about 2 years ago and we looked at all the activity that was taking place in CGM around the regions, most of our activity at that time fell within the first 3 sectors here. But as we evolved, as the transition has accelerated, as we've seen more activity from our clients and activity internally, we added a 4th vertical, a 5th vertical. And now our activity falls up under 7 verticals that you see on this screen. And what we're really doing is we're leveraging the capabilities that we already have across the horizontal lines here. And we're leveraging those activities into these newer opportunities that we see. And remember, these are the same businesses that we're in today, and these are the same clients that we're working with today. So let me take you through a few examples in a little more detail. In our carbon and emissions business, we've been in the emissions and environmental and in the environmental markets for more than a decade now. Through our carbon team, we have a fully integrated model that also provides capital to carbon projects. We help clients source carbon credits, and we help clients risk manage price exposures in those carbon markets. In renewable and flexible power, we're building on our power and transmission businesses, which we've been in since 2006, and which Tim took us through earlier this morning. We're now leveraging those same capabilities in the renewables energy space, and that's for things like solar and waste to energy. We're focused on flexible and peaking power solutions with our battery, rapid response, even hydrogen fuel cells. We're executing on opportunities in commercial rooftop solar and also smart metering. We touched on clean fuels earlier with Dan and David. I won't go into any more here, other than just to underscore that when we decided to bring our agriculture and our oil businesses together a few months ago, one of the real key reasons we did that was to ensure that we were very well positioned for the opportunities that we were going to see, and we already are seeing, in clean fuels and renewable fuels. The last thing I think I'll highlight is around critical minerals and that critical minerals value chain. This is a really important space for us. Our long-standing expertise around metals trading and mining finance businesses. We believe this is a very large growth area, not only for CGM, but for Macquarie as well. We are increasingly focused on those critical minerals needed for the energy transition. We're already active across a variety of upstream, midstream, and downstream metal sectors, and this includes metals like copper, nickel, lithium, cobalt, and even uranium. We also work with clients on end-of-life metals recycling and recovery, and improving the circularity of those critical minerals. And lastly, I'm going to land on 4 case studies that really kind of exemplify the activity that we've been in very recently. And the first one is TerraFame in the top left here, and this really follows on to what I just mentioned about our critical minerals value chain. It's a really excellent example of how the various parts of CGM came together to deliver a comprehensive solution for a client. TerraFame is a longtime CGM client and a global supplier of intermediate nickel and cobalt products into the battery supply chain. Their position is one of the world's largest production lines for battery chemicals, sufficient enough to supply 1 million electric vehicles per year. So what do we do in CGM? We provided a long-term working capital facility to support the ramp-up of their newly built battery chemicals plant. We provided a physical supply intermediation agreement. We continue to provide hedging across all their various metals. And we also provide asset financing and asset leasing on their surface mining equipment. We're very pleased to be a key partner to such a globally significant producer of battery chemicals, without a doubt. The second example is Pacific Cambrian Energy. This is around responsibly sourced gas that we showed the video on earlier and that Tim touched on as well. The only thing that I would underscore there is that it's a really good example of some of the things that we're doing in oil and gas and one of the harder to abate sectors here in CGM. The third case study is around carbon removal and also a part of our global carbon team's business plan, and that's around our cook stove projects. So CGM invested alongside our partner, Sequest Capital, to distribute cook stoves to 3.7 million households in developing countries in sub-Saharan Africa. And on top of all the important social benefits that this project brings to the women and children of these households, this program is expected to result in the abatement of over 200 million tons of carbon over the next 10 years. And our global carbon team then works alongside all of our client teams in all of our regions as they reach out to our consumer clients who are looking to acquire carbon offsets as part of their portfolio. And then the last case study here, it's a smaller transaction, but it's a really important transaction that I wanted to highlight because, again, it's in the oil and gas sector, and it's around utilizing stranded gas for electrification. So basically, we came in and financed a fleet of mobile gas turbines for an oil field electrification provider. These turbines generate reliable electricity from stranded gas that would otherwise be flared or escape unflared into the atmosphere. And these turbines basically replaced electrification that previously were run on diesel. So all in all, as the transition continues, we would expect to see many, many more of these types of opportunities to assist our clients as they move down the path to a lower carbon future. And in CGM, we feel very well positioned to be able to do that. So now I think I'll turn it over to Nick to take us through a little bit of what Macquarie Capital is doing.
Perfect. Thanks, Janet. And it's great to be here today listening to how CGM is growing into adjacencies along both the energy transition and in its existing businesses. I'm Nicholas Goll. I'm a Senior Managing Director based here in Houston. I look after energy transition for the infrastructure and energy capital team within Macquarie Capital. I've been with Macquarie for more than 20 years, always part of Macquarie Capital. And a constant theme of Macquarie Capital over those 20 years is its ability to continue to grow and evolve with markets. So for Macquarie Capital, the energy transition provides a great opportunity for us to continue to grow what are already market-leading franchises in the infrastructure and energy sectors, sectors that we have been a leading player in for many decades. We have a truly global and connected footprint with over 230 infrastructure and energy specialists across 20 countries. This brings us unmatched expertise in these sectors, as represented by the fact we are the #1 global financial advisor in both infrastructure and energy for multiple years. Most importantly for us, the energy transition doesn't just touch our energy clients, but as Janet mentioned, the energy transition is impacting all of our clients in all of our sectors, whether that's consumer, technology, or aerospace and defence. This means that the more than 1,600 Macquarie Capital team members are all working with their clients to help them achieve their energy transition goals. Yesterday, you heard a lot about Macquarie Capital, and hopefully you took away that we provide more than just advisory and capital market solutions. We provide a broad and unique range of products to help our clients navigate this transition, whether that's private credit through Bill Ackman's team, growth and technology through Larry's team, or development and investment opportunities through my infrastructure and energy capital team. But MacCap, as you took away from yesterday, hopefully, is not about being all things to all parties. We try to focus on areas where we can add true value to our clients, and we do believe that the energy transition is one of these sectors. Janet touched on the massive capital requirements needed for the energy transition. It's estimated that the spending on energy transition will need to rise to up to $4 trillion by 2030 to hit net zero targets. This acceleration of capital provides Macquarie Capital plenty of runway for us to grow our market-leading advisory and principal investing businesses, particularly here in the US, where you've heard a lot over the last couple of days about the Inflation Reduction Act, which provides strong tailwinds for the businesses here in the US through significant tax incentives and grants. For Macquarie Capital, its investment and asset delivery capabilities are a true differentiator for us, for our markets, and against our competitors. This allows us to provide deep sector understanding, which only comes from the real-life experience we get developing, constructing, operating assets and businesses. And for us, we have a broad sector focus. We're focused on an orderly transition, meaning we're looking at both the established sectors, such as LNG, power, and midstream, as well as the emerging sectors, waste to energy, clean fuels, and the emerging energy technologies. All of these sectors will play a key role in the energy transition for our clients. In summary, we're connecting our deep knowledge of infrastructure and energy with capital to help our clients get real results. And we're doing this importantly as Macquarie Group, not just Macquarie Capital, working with my colleagues in CGM and the other businesses to deliver real results to our clients. But to bring to life what we do in Macquarie Capital, I wanted to spend some time on 4 case studies. As John mentioned in New York yesterday, within infrastructure and energy capital, we formed a clean fuels business, Aerogy. We're in the final stages of construction and commissioning of its first project in Wisconsin. This project will provide about 200,000 MMBTUs of renewable natural gas into the grid each year. We've heard about RSG, but renewable natural gas in this case is created from animal manure, a waste product, which is converted through proven anaerobic digestion technology into pipeline quality natural gas. We then inject this gas into the natural gas pipeline system, and it's utilised in the Californian vehicle transportation market. We're also working closely with CGM on this to help analyse the environmental credits associated with the renewable natural gas and to ultimately hedge it to help provide risk management for our investment in the platform. This project is the first in a pipeline of projects we're looking at through the Aerogy platform, which has gotten a significant boost through the Inflation Reduction Act, allowing us to accelerate our capital deployment into this platform. The second example is through Larry Handon's Growth and Technology Group. We've invested in a leading battery tech business, Form Energy. This business is commercialising low-cost, ultra-long duration energy storage. Its first commercial product offering is an iron-air battery, which is capable of storing approximately 100 hours of electricity versus about 4 hours for a traditional lithium-ion battery. This can provide storage which can bridge extended market disruptions, which is key as renewables such as solar and wind continue to play an increasing role in our energy mix. Investments like these are helping us commercialise the technologies that will stabilise energy markets in the coming decades. On the advisory side of the business, we have helped our infrastructure clients invest recently in AMP US, a leading renewable energy and battery storage developer. AMP is deploying distributed generation projects across the US in the form of solar and batteries. This 200 megawatt platform will help abate around 170,000 tonnes of CO2 per annum by 2024. In this case, we're using our deep sector knowledge to help our infrastructure clients invest in the growing and emerging energy markets. Lastly, given the importance of energy security and an orderly transition, we formed Wavecrest Energy, an LNG regasification business headquartered here in Houston. With the Wavecrest platform, we were able to react and provide solutions to the energy crisis in Europe last year. And we invested in Deutsche Ostsee, which is the first private LNG regasification terminal in Germany. Given we had already established the Wavecrest Energy platform, we were able to make this investment in a matter of months. In addition to the financial investment, Wavecrest helped the project through its development and commissioning phases, and the project delivered its first natural gas into the German gas grid in January. This project can supply approximately 5% of Germany's natural gas demand and is one of several projects that Wavecrest is looking at to help supply LNG to new markets. The LNG story within Macquarie is one that's deeply personal for me. I've been working with the colleagues in CGM around multiple transactions over many years, starting back almost a decade ago with Freeport LNG. And that transaction was actually the impetus for me to move my family from New York to Houston to be much closer and work with the CGM colleagues to bring about whole-of-house solutions. So these are just some of the many examples within Macquarie Capital. We're helping our clients, partners address the energy transition. We're doing this as Macquarie, working with our colleagues in CGM who are helping us understand and manage the risks of these transactions and to help provide solutions to our clients. As market-facing businesses, we are both building our capabilities into adjacencies to continue to grow our market-leading franchises. So with that, I'll wrap it up and hand it over to Glenn to talk about FIC.
Good morning. I'm Glenn Edelson, and I look after the FIC business in the Americas. I joined Macquarie 13 years ago. Previously, I worked at Goldman Sachs and Morgan Stanley. I was looking for something a little more entrepreneurial, and I've certainly found that the last 13 years, building out the FIC business in Americas at Macquarie. What is FIC? FIC combines three complementary business lines: FX, rates, and fund finance. We have 250 counterparts globally, run by local staff and long-serving managers. What do we cover? We cover the FX space, both G10 and EM. We cover most interest rate markets. And in fund finance, we provide credit to PE firms. Who are our clients? Our clients are private equity firms, credit firms, infrastructure and real estate managers. We also cover some corporates, some real money funds, hedge funds, and a few family offices. In the next slide, we'll see a few highlights of our business. As you can see, FIC Americas operates in two segments: the capital and financing segment and the risk management segment. In FX and rates client hedging, we have 25 professionals in New York, a 14-year average tenure for executive directors. We cover over 500 individual funds. Over the past 2 years, we've done $200 billion in fund level hedging and $8 billion in portfolio level hedging. On the funds finance side of the business, we have 10 professionals in New York, an average tenure of 12 years for executive directors. We've done 110 deals comprising over $11 billion in financing. So we launched our US FIC business in 2009 and have built a diverse client-focused business since then. If you look at the slide, in 2009, we started out covering some hedge funds and real money accounts. We quickly realized we really weren't competitive in that space. We expanded our coverage over the next few years to corporates. But the real aha moment came in 2013 when we did our first private equity hedge. We saw an opportunity to become a meaningful player in a quickly growing asset class. We pivoted our focus at that point to private equity. As you can see in the slide, by 2017, we had 5 private equity managers onboarded. By 2019, we launched our portfolio hedging business, leveraging the deep knowledge and relationships that MacCap has. You move to 2021, we jumped to 50 private equity managers onboarded, and that brings us to the present time. We have over 60 large private equity managers onboarded, over 500 individual funds that we trade with. In fact, over the last 2 years, we've done 30 portfolio hedges. So as you can see from the slide here, private funds are growing dramatically. It's been a massive growth over the last 12 years. 2010, we had almost a little bit over a trillion. Now we have over 9 trillion. Also interestingly, is we've grown our market share. So currently we cover 10% of all these asset classes for hedging. If you look a little closer at this chart, you're going to see we have a much higher market share in private credit. And that's related to the fact that private credit firms generally hedge their FX exposure more rigorously than other strategies, just given their lower return profile. But it's also related to the fact that we can leverage our settlement solutions team in the private credit space, as well as the relationships from the principal finance team in MacCap. And I know Bill Ekman spoke to you a little bit about the business they're doing there yesterday. In essence, though, you look at this, we're about 10% market share. We have a lot of room to grow. We're significant, but there's a lot of room for us to grow this business moving forward. In the next slide, you can see that over time, FIC revenue has grown globally. But an increasing share of that is coming out of the Americas. In fact, in the first half of this fiscal year, 50% of all FIC revenues came from the Americas. Now I'm going to move to quick case study. Carlyle is a large private equity asset manager that I'm sure you're all familiar with. We onboarded them in 2017, and they have $400 billion in assets under management. We were able to onboard this client by hiring some senior originators who have some great relationships. However, beyond the relationships, Macquarie has a strong PE offering for clients. Unlike our competitors, we cover clients off a multi-product sales desk where we do both FX and rates. We work seamlessly with the financing teams in Settlement Solutions and our MacCap PE coverage colleagues. Clients appreciate the one-stop service. We also onboard clients quickly. And finally, clients appreciate the diversity of a highly rated Australian bank as a counterpart. As you can see from the slide, since onboarding them, we've become very relevant to Carlyle. We've been doing FX forwards, interest rate swaps, portfolio company interest rate hedges, and short-term lending via the Settlement Solutions product. And if you look at the growth, 2017, we had our first fund, and we're actively trading with 13 distinct Carlyle funds now. So this is an interesting story, but what it brings out more is it's not just Carlyle. We've done this across a wide array of the alternative asset universe. While Macquarie has built a strong niche in FX and rates hedging for PE firms, we are growing our broader franchise by investing in adjacent business lines. This includes our fund finance business. Our PE hedging business and our fund finance business are complementary. Since moving fund finance into FIC a year and a half ago, we've been able to market clients with a broader and much more comprehensive product offering. The result has been new clients for both teams. In fact, in our last fiscal year, 50% of all of our new financing deals came from introductions from the hedging side of the business. We see a growing opportunity in fund finance given the current macroeconomic environment. We're seeing longer fundraising timelines and slower asset realizations. This is clearly going to provide new opportunities for fund finance. Beyond fund finance, we see opportunities in our LATAM FX and rates business and in our digital offering. Increased volatility in Latin America and the exodus of European banks has created an opportunity for Macquarie. Our LATAM team is leveraging CGM and the broader firm to bring in new corporate clients with a focus of those in the commodity space. To date, as you can see on the slide, we've onboarded 23 corporates, 30 e-commerce clients, and 6 family offices. Similarly, we are investing in our digital offering. Our new Aurora platform allows clients real-time access and execution capabilities. The offering is helping us scale our business to a much broader set of clients. Active users are up 38% year on year. Macquarie's FIC Americas business is still developing. We continue to explore and add adjacent business lines. We're confident the growth will continue moving forward. Thank you. With that, I think I'll hand it over to Nick.
Thanks, Glenn. That was great. Hopefully, this morning's presentations have given everyone an opportunity to get into a bit more detail of not only CGM globally, but specifically what's happening here in the Americas. And hopefully you can understand why we're so excited about what the future holds here. Just the sheer size of the market plays really well to our strengths. It plays really well to our client focus and the way we build into adjacent spaces. And we're seeing across all of the industries and business lines that we're operating in more and more opportunities as we go forward. So we're really excited about that. We're doing it, of course, under the risk framework that's been developed across Macquarie over 30 years and lessons we've learned over our 53 years of profitability as well. So at this stage, I might, if people are interested, give the opportunity for Q&A.
Great. Thanks, Nick. That was great. So we've got a bit more time today. I know you all wanted a few more questions.
Fantastic.
And thought that Nick might want to take a few more questions. So we've probably got 50 minutes, and then I'll ask Alex Harvey, our CFO, to give some closing remarks. So I'll go with Andrew Lyons.
Andrew Lyons from Goldman's. Nick, a number of times through the presentations today, asymmetric optionality was mentioned, particularly in relation to the commodities business. Now, generally when we hear that, we'd expect some form of competition to sort of enter and maybe compete away that asymmetric optionality, but your recent results suggest that that hasn't particularly been the case. So I just wonder if you could just talk to the competitive environment for your various businesses, and particularly how the type of competitor has evolved over the last couple of years.
Sure. Thanks for the question. And of course we have competitors, and of course we operate in competitive environments just like the rest of Macquarie across the Americas. And that environment does evolve, but our competitive landscape is different depending on which part of that market that we're operating in. So, for instance, in some cases we might think of a major oil and gas company as a competitor in a trading business, but in our financing business they're a client. So we're really agnostic as to who our clients are and where they come from. It's okay if we compete in one market and they're a client in another market. But in terms of the asymmetric nature of some of the trading risks that we take, the reason why we're able to continue to identify a lot of those opportunities, and you'll see this later today when you go to the Houston office and to the trading floor, you'll just see how many people we have that are focused across delivering these services and outcomes for our clients, and also identifying opportunities for us. And that's really where our advantage comes from. It's having that scale that we've built over a number of years via acquisition, but also organic hires. And we believe that we're able to continue to identify opportunities because of that level of expertise and because of that level of scale that we've brought to trying to solve the problem.
Thanks, Nick. I can't have the first question without also maybe asking about Kansas City. And obviously it's been in the news recently that the Attorney General is seeking to sue Macquarie for market manipulation. Obviously it's a case, so that it might be limited in what you can say, but can you make any comments around the case, or sort of provide some background on the facts of the case, and also how do you just more broadly manage this type of risk?
So it is an ongoing issue, so I can't comment on it specifically. However, perhaps some background, we do operate in markets that from time to time are experiencing levels of stress, and what we're doing is we're responding to client needs, and we're responding to the needs of the community. And as a result, we're buying gas and transporting it and moving it around in times when prices might be elevated. And that's probably part of the background of that particular issue. In terms of how we manage these types of risks, I pointed out earlier we have non-financial risks associated with our business that we manage just as robustly as we do with our financial risks. And when you again go and see the floor later on today, and this is going to be the power of actually being able to show this to you, you'll see we have I think it's nearly 50 people are going to be there, Tim, in terms of our risk management people. So people who are there that are monitoring the trading that's happening on a real-time basis. People who are there who are looking at the types of deals that we're doing, asking the question that David asked earlier. It's not could we, but should we? And you'll see that when you come to the office later today. So I think. When we build out our new office, which you'll hear about when a little bit later on, I think we're going to have room for 50 people that are going to help us monitor those risks on a real-time and daily basis. They are very much part of the team. They're there. They're actively on the floor during the trading day. They're liaising with our people real-time. They're reviewing and they're challenging.
I've been asked to move to the other side, so I'll do that. Ed.
Thanks. Can I just follow on from Andrew's question? Can you just touch on regulation risk, where you're seeing it at the moment, how you think it potentially evolve in the future? Around the commodities, around the gas business?
So in terms of the
risk you're facing, like what the environment is at the moment, and obviously with things evolving and you're moving gas around, do you see increasing regulation risk going forward for this business?
Look, we operate in a highly regulated environment, and it's our responsibility to operate within those regulations, and of course we do that. But what we focus on is what are the solutions that we're delivering for our clients, and how are we doing that? And from that perspective, we feel comfortable that there is an opportunity for us to continue to do that. We think we're well placed in doing that, and we feel comfortable with that.
Okay. Can you just move on? You've made on some successful acquisitions in the past, and you touched on a few of those today. Can you just talk about your business, your scale at the moment? Is there opportunities more domestically in the Americas, or is the opportunity to expand more so in Europe and Asia going forward for CGM more broadly?
Yeah, I'll start with the second part first and then get to the first part of your question. We are seeing quite a lot of opportunity at the moment, particularly in Asia. We've recently started our our gas and power business in Japan. We think that the Japanese market's going to be very prospective for us. We're starting to build up a really big customer base, and we think the type of solutions that we're bringing to that particular market are unique, and we're confident that we can be of value to that market. Europe's been really interesting as well. With the change in the supply landscape across Europe, which you all know very well, it's meant that the infrastructure, which previously was perhaps less economic for non-utility based customers to take part in, has started to change a little bit. And we think there might be more opportunity for us to grow into Europe, into some of the physical sides of the business, which we're excited to see how we might be able to service clients from that perspective. And then here in the Americas, there was a reason why I talked about the Cargill example, because it just really was a reminder for us that just the sheer scale of this business is such that there is always something else to do, whether that be in the traditional forms of the business or whether it's into the energy transition opportunities that we talked about. And we went through a lot of examples of different types of things that we've been doing, and every conversation, I'd say, Janet, that we have with a client at this point now touches on the transition at some point, whether it's an immediate opportunity or whether it's an opportunity of something in the future. So North America being the place that it is, we're very excited about where we might go. We think our scale is an advantage. We don't necessarily think that's a disadvantage for our growth in the future.
And just on that growth, is it, if you think about the different regions, is it more physical? Obviously you touched on in Europe, but is in America and Asia, is it more financial, like if you think about the potential expansion, or is it both physical and financial?
Well, I think it's sometimes it's easier to start with a financial expansion and then transition into the physical. It really depends on the individual markets and the individual opportunities that present themselves at the time. But the way we build out the business is we ask ourselves, what is it that the customers are actually asking for, and where are they taking us? So that's what will drive what we're trying, of how we'll build out the business. So in Europe, we're getting asked for more physical solutions at this point in time. In Japan, the opportunities that we're looking at are a little bit financial in nature, but we do plan and think that there'll be plenty of physical opportunities in Japan as well.
Okay, thanks.
I'll go to Andrew and then I'll come to you, John.
Thank you. Nick, just Tim indicated in his presentation that he sees growing volatility over the next decade. However, you are coming off probably the best conditions the businesses might have seen for many years. What's the near-term outlook for volatility across the various product lines, and where do you see the medium-term outlook versus perhaps either the recent years or the pre-COVID levels? And in that context, are there any changes you see in investment in the pipeline network that might reduce the level of dislocation you're seeing in the markets?
I'm going to try and answer all those questions. So look, I'll start off with volatility. Yeah, no doubt there's been some volatile market conditions which we've navigated over the course of the last couple of years. And I think we've stood up here before and we've said we don't expect that to continue. But we've also, Tim went through in his presentation a whole host of reasons why we might continue to see volatility, at least across the US. What we're seeing in Asia and also Europe is changing supply and demand dynamics, and that generally translates into volatility whilst the market gets used to them. Tim, you might have a perspective on volatility going forward. And I know you've got a view on how difficult it is to get pipelines built in North America. Perhaps give us some context there.
Yeah, I don't think we'll see many pipelines get built outside of maybe Texas. But for all the reasons we're seeing volatility, I think people look at the underlying Henry Hub price going down, and we still see volatility. Like, the price is down at Henry Hub, but like California is $8, and then winter Northeast is very expensive. So it really depends on the location, but there's no reason for the volatility to slow down. We're going to see it in the hourly markets, the daily market, the seasonal markets, and we're not optimistic on a lot of gas infrastructure, power, or being built over the next few years.
Thanks. Can I just have, follow up there just on the physical business, perhaps, Tim? If you look at the top players in the US market, it's probably dominated by integrated oil players, but also a spread of other private trading commodity houses, and many of which would probably have smaller balance sheets. How does Macquarie's sort of unique position as quite a large-scale financial player with a decent-sized balance sheet sort of give you opportunities but also challenges to compete in that market?
Well, as far as the balance sheet, I mean, we have seen after Uri, customers seek higher quality credit. So we have seen incremental deals that are a function of our balance sheet. So and we think that continues. I mean, we're very active in the client base, and you have to have credit to be in business. Each one of those parties that you look at, it's a different model. They're very different models. You have producers in there that are focused on moving their equity volumes. You have pure trading houses. You have some. The banks look very different than us. So it's they may have a ranking with volume, but it's a different model.
Yeah, I think just to add to that, the diversity of our product mix combined with the balance sheet means that we can come up with unique solutions for the client base. And that's where we think we're differentiating ourselves from everyone else. So our balance sheet is certainly a big part of it. Our focus on clients and our ability to bring different parts of the value chain, bring them all together and come up with client-driven solutions, we think is a competitive advantage.
John Mott from Barrenjoey. If I can bring up slide 11, I think it was an interesting one. I'm not sure if you can pull it up, but it's the one that you showed the revenue by day and how it's moved in the last few years. It was sort of averaging 10 million. Not sure if the guys can bring that up, but it was averaging about $10 million a day. But this year it's been a bit of a breakout year, and you're sort of seeing a lot more of that fat tail revenue, and it's averaging a lot more. I just wanted to see, do you actually see this as a step change where you're going to have a lot more days where you're making 30, 40, $50 million and then a few very, very large days when you get the weather events or whatever happens? Or was this year, as we talked about, more volatility, unusual volatility, a one-off, and now we're going to revert back to the other days where we're going to have more general $10, $15 million per day? So is this a breakout in the change of that slide? Or are we back to where we were? I'm not sure if you can bring that slide.
Can we just get that slide brought up, if that's...
Yes, you can see the black line on FY23. It's a lot lower and much pushed out to the right, so you're getting a lot of days in that $30, $40, $50 million. Is that the new norm that we should be thinking about, or is this the blowout that we've just seen, given you've had such a fantastic year?
I think what the takeaways from this slide for us, one, yes, there's been some volatility this year which has driven outcomes, but there are two things that we take away from it. Firstly is it's comprised of all income, so it includes the income that we're generating from our client activity as well. And our client franchise this year has grown significantly as well. So you see when you look at the reg cap breakdown as well, when we see how much capital we're holding against market risk versus how much capital we're holding against credit risk, you see that the proportions are still relatively the same. And so yes, we're taking a little bit more market risk than we have previously. There's been conditions that have been favourable for that type of activity, but we've been doing it in line with the franchise. So my expectation is that our client franchise will continue to grow into all of the adjacencies that we've talked about today, as we have over the course of the past few years. So my expectation is that that will continue. And as that franchise growth continues, there's opportunities for us to take a little bit more market risk, again, commensurate with where our franchise is, because we like to size the type of market risk we're having in line with the overall franchise. Now, in terms of where volatility goes and what happens, in the future, it's difficult for us to forecast that.
And a second question, and it kind of goes back to what Andrew Lyons asked at the start. As you move into adjacencies, sometimes you're working with clients, sometimes you're trading on principle. And when you see these kind of positions, as we've seen in equities, eventually you need to have Chinese walls, information barriers, what you want to call it, between them. How do you balance that in a business which is as integrated as yours, where you try to have lines of communication, that you balance the reputational risk, that you don't have trading for principle, trading for agency, and therefore end up in a situation where you can be perceived to be not acting in the best interest of all the market participants?
Yeah, it's something we spend a lot of time on, something that we've been focusing on since the inception of the business. And there is clear demarcation across who is covering which part of the client base and who's covering other trading activity or other activity within the business. So it's kept separate. So there is a protection there for our clients in terms of any activity we're undertaking on their behalf. So it's unlikely that we're actually competing with and trading in a client sector in exactly the same sector. It's generally different parts of the market.
So if you're making, in a certain case, you might be trading in a commodity or a certain energy and then having derivatives in a different part which will benefit from that. There is a clear information barrier between the two?
Yeah, that is managed separately by different people.
And is there an information barrier between the two people? There is, thank you.
Start with Brendan.
Hi, Brendan Sprouse from Citi. I just got a question on the capital intensity of this business as we look forward. And as you can see on the slide, there was a big step up in the credit risk in 2022. As we move into sort of tougher economic times, and if the economy slows or even if it goes into recession, in order to trade at the velocity that you are at the moment, will you need to step up the capital that you invest in this business?
Look, I think our approach to investing capital in this business is one where if there's a return on capital available, then hopefully you'll make it available to us, Alex. So, and I will pass over to Alex in a minute, but I'll just make one comment before I do. The peak in March 22 of the credit capital, a lot of that was driven by two things. One part of it was driven by increase in customer activity, and the second thing was increase in exposure in our derivative book, which was driven by spikes in primarily the gas and electricity markets. And what we've seen over the course of the last 6 or so months is that's come down significantly. So our credit capital will probably be a little bit lower whilst prices are lower, despite the fact that we've continued to grow. But I don't know, Alex, have you got any comment on capital?
Yeah, thanks. Brendan, yeah,
just a few other things on capital from my perspective. One is you obviously saw some change in the capital regime. We've seen unquestionably strong come in Australia, so that's obviously changed the capital footprint from an overall NBL perspective anyway. So that's one thing to bear in mind. You know, as Nick said, I mean, if you look at our most recent 3Q, we talked about $12.5 billion worth of surplus capital, and you know, one of the things that we hold that surplus capital for, obviously, is being able to step up to support the clients in good times and in bad times, and that's really important. I think one of the things that Nick and I and the team talk about a lot is the fact that if you want to build a client-orientated business, you've actually got to be there when things are good and you've got to be there when things are bad. And so when we think about the capital footprint and indeed the funding footprint for the group, what's really important for us is to be able to say to Nick and his team, go out there and find those opportunities with the clients, and we'll be there to support you. So if the market does turn down and that creates opportunities for Nick and the team, what we want to do is we want to be there saying there's capital available, provided obviously you can get the right return for utilisation of that capital. I mean, as Nick said, you know, what we saw, you know, in March 22, and you saw it even in September 22, we saw elevated levels of credit capital associated with the volatility and the level of activity we've seen from clients across the world, and the absolute prices that we saw across a number of commodities. You know, that's obviously come down a bit. You can see that in the December 22 figure. But you know, at the end of the day, if the market opportunity is there, what's really important in a client-orientated business is actually to step up and be able to support it. So, thanks.
Go to Brian first. Just at the back. Yep.
Brian Johnson, Jefferies.
Oh.
Thank you very much for great presentations. Just looking at that slide 11, if we were to go back to 2014, there was a convenient polar vortex right at the end and the line would have spiked up. If we'd been sitting here a year ago, we wouldn't have had the black line. We'd all be looking at the yellow line saying there was one in 2023. That chart, I believe, actually goes up until December 2022. We've seen a slide today that speaks about it's all about geographic kind of disruption. And as I'm looking at my phone this morning, I'm getting lots of warnings about basically snow on the west coast versus a very mild period here. Is it hard not to conclude that that black line would be even higher right now than it was at 31 December? It looks like it. Is that something wrong in putting those pieces of information together that you've given us?
In terms of the line that you can see there, that's the information which we've made public at this point in time. We respond to market conditions as they present themselves, but it's probably also fair to reflect that not every single market opportunity that's ever presented we're able to take advantage of, or there's a customer demand for us to be able to supply that solution. So I'm not sure that you would just extrapolate if you just see some kind of disruption or dislocation that translates specifically to our business. But over time, we've tried to give you a feel for the general trends that we think drive our results.
A question for Alex, if I may. Alex, if we think about across the group, we see this pretty conservative approach on the ECL provisioning. Mm-hmm. You've said that the capital requirement went up as the gas and electricity spiked up. The credit requirement went up in particular. Mm-hmm. I know that normally you really concentrate on having kind of right way trading, but has there been, with the black line squiggling up, has there been any ECL provisioning taken in respect of that? Or is there no need to because clients made money?
No, so maybe just explain it. So the ECL provision really relates to the loan assets, on the loan and lease assets on the balance sheet. So you're really assessing how much provision you need to carry against those loan and lease assets. As you said, Brian, if you look at our ECL provision, and part of that obviously sits in the CGM business. Nick talked about the provision of financing for receivables, for the sake of the example. You know, in our specialised and asset finance businesses, obviously ECL provision is associated with that kind of activity. In relation to the other part of Nick's business, obviously, is credit capital associated with the derivatives business. And that derivatives business, you know, basically what we look at obviously is a mark to market in those derivatives. We also hold reserves against those derivatives. So where you see, and this all obviously just comes through the daily P&L in terms of those reserve movements. So we're not pulling out specifically the provisions associated with the derivatives portfolio, but under the accounting standards, you've obviously got to hold reserves against the valuation of those derivatives. Those reserves are for things like crossing the spread, for the sake of the example. Can you get out at the sell price or the buy price or the mid price? And they're also for things associated with credit risk associated with those counterparties that you're actively involved in providing risk management solutions to. So during this period of time where you see high levels of volatility, we're obviously continuing to look at the reserves, and those reserves are really saying, what's the credit quality of the counterparty that you're dealing with, and those reserves also reflect what's the changing credit quality of us as on the other side of that derivative. So that's where you see the provisioning associated.
So you get pinged a little bit on the capital and the reserving.
Yeah, you're holding capital against your future exposure basically for those derivatives. So yes, it runs through the capital position. That capital footprint is obviously much more related to the APRA application of the Basel standards. So that's just the normal bank framework that you're familiar with as I guess utilised by or amended by APRA. But what we do as part of our accounting for those derivative exposures is we're holding reserves that reflect the credit quality of the counterparty we're dealing with. Those reserves also reflect our credit quality, because obviously our credit quality changes from time to time. We're holding reserves for, as I say, crossing the spread. So if we want to get out of a position or into a position, what would it cost us in terms of the bid-ask spread? All of those come through a calculation which is basically called the XVA calculation. So it's an aggregation of all those reserves. We bring them through our P&L on a daily basis. I mean, you obviously see the ECL that sits on the balance sheet and we talk about it. Within Nick's business on the derivative side, what you're seeing is the XVA, which is a reserve against the derivative exposures basically we've got.
And if I can just push my luck, with the risk management framework that you're doing, there's two ways you can do it. You can basically have a capital at risk or an earnings at risk. Macquarie years ago used to be very much an earnings at risk house. Can we just get a feeling, when you're talking about the worst case, what is the worst case? Is it that you have a hole in the earnings, or that you lose a big hunk of your capital?
Oh, I'm happy to answer it. I mean, Nick obviously made the point. If you look at our risk management framework, consistent for a long period of time, what are the three essential elements? Firstly, business own the risk. Secondly, worst case outcomes, and that worst case outcome is all about, can the business, in terms of its earnings, can it support that worst case outcome? That's really, really fundamental to what we do. And thirdly, obviously, there's independent sign-off from a RMG perspective. Nick?
Yeah, and that cascades down to our individual business lines as well. So when we're trying to size our risk appetite for an individual business line, so one of those 11 business lines that might be in commodities, or one of the business lines that's in FIC, we'll try and size that risk appetite around their earnings shock. So whether they can actually survive that worst case outcome, whether the business will still exist. So we're not trying to risk any individual business line when we're sizing that.
Yeah, I mean, 100%. Sadly, we get stuff wrong, Brian, obviously, and you've seen that, right? So we do take losses, and we don't like taking those losses. So when we think about our business more generally, what are you thinking about? You're thinking about diversity of the business across, not just in CGM, but across the whole of the group. And we also hold lots of surplus capital and surplus funding. And why are we doing that? Because plainly, even though we think we're good risk managers, and we have been, long track record of being good, we get things wrong. We want to be able to absorb those things that we do get wrong from time to time.
Said so the business, Alex, sorry, you were saying so the business earnings could survive the worst case, and you said so the business could survive the worst case. They're slightly different.
I'm sure we're not drawing any distinctions.
No.
So when we think about it, if the business earnings look like this, right, $100 million, what's the worst case scenario? Can that $100 million of earnings, can that support the worst case outcome we might incur for entering into this transaction?
So it's earnings at risk.
So the way I think about it is, can I continue with that business if I lose those earnings? Can I still sustain the costs? Those types of things. So it's an earnings-based issue as opposed to capital.
Right. John Story at the back. Thanks.
Thanks, John Story, UBS. Nick, obviously your business has had a fantastic 2 years, right? And it's really kind of found a new scale. One of the things you've called out in terms of medium-term opportunity is around inorganic growth opportunities. So when you sit in front of your clients, what do your clients feel like Macquarie's still missing in terms of their offering?
That's a good question. Look, in terms of what we think we can do across all of the people who spoke today, I think there's more clients that we can cover. I think Glenn, in your world, whilst you've made tremendous progress, you're covering 10% of the addressable market, particularly in the oil business and the agricultural business. We feel like there's a tremendous amount of scale that's left for us to be able to continue to grow. There's always new customers that we can address. Certainly from the energy transition perspective, we feel like of those 7 verticals that Janet talked about, we're only just starting on a few of them. So there's the opportunity for us to continue to develop those. And on the gas and power business, firstly in North America, there's the opportunity for us to continue to grow our client base here as well. Whilst we do have some scale, I used the Cargill example. When we did acquire the Cargill business, there's a whole bunch of transmission that came with that business, for instance, which we didn't previously have. And we think that we can continue to grow that footprint across North America. And I touched on earlier, European gas and power. Looks like there's some opportunities to scale the physical business there and continue to grow our offering out of Macquarie Bank Europe, which is the entity we used post-Brexit to access our customers in Europe. And of course, in Asia, I think our footprint is less developed than it is in some of our other regions. And we feel like there's a lot of opportunity there. So Dan, I don't know if there's any comments you want to add on Asia specifically or related to oil?
Thanks, Nick. Not really, but I think you covered it really well. And having just got there and realising like what the opportunity was here in North America, realising how much opportunity still exists in Asia, and part of the Asia power and gas business building out in Japan, we're finding new customers in Japan that actually do more than just power and gas with us, and we're doing a lot of other new products, and we've realised that we can roll this out and we're going to try and do it into other regions, and there are big economies in Asia that we think that we haven't properly serviced yet, so we're excited about the opportunity in front of us.
Yeah, I think just to add from an Asia perspective, traditionally we've seen that as being an over-serviced market, and as such we have focused a lot of our efforts elsewhere in terms of deploying the capital just on a returns basis. And I think what we're seeing now is with the changing landscape of people who are servicing that market, that there is an opportunity for us to get a return. Clients will pay us for the service that we're providing. And you know, one of the main reasons why Dan is in Asia is to take some of the learnings from the expansion that you know he oversaw in London and then here in Houston back to Asia.
Maybe just another one then. Obviously, you've grown your client franchise significantly over the last few years, and you've obviously seen quite a big increase in revenue coming from the commodities piece of the CGM division. How do you guys internally think about the shape of that revenue, kind of more agency kind of business, annuity style, predictable, kind of like a baseline revenue for CGM, or rather for the commodities piece, outside of some of the volatility stuff that you spoke about this morning? I mean, how do you guys kind of run the business on a baseline revenue number?
Yeah.
And what does that look like?
Yeah. So I think in one of the slides here, we showed how we break down our P&L here, and the way we sort of think about it in terms of repeatable or income that we have confidence in. So we have a lot of confidence in the client-driven aspect of our business. Now, part of that is going to be driven by underlying activity in the market. If volatility goes to zero, our clients will do less. But the diversity in the portfolio gives us confidence that if one business line is less active in any given year, it'll be replaced by another business line. And what I tend to look at, at the start of the year, and when we're talking about forecasting and those types of things, we try and think about, okay, what is that repeatable nature of the client-driven income? And then we look at the optionality in the trading business, whether that's from the physical inventory management line or whether it's from optimization line or another trading line, and we try and work out what might be a reasonable expectation in a given year. So some of the things that might go into that will include our expectation of volatility, although it's very, very hard to forecast what volatility will be in the future. We're not experts at that. If you are, let me know how you do it, and you come work for us.
We go to Kieran. Thanks.
Thanks, Kieran Chidgey from Jarden. Just looking at slide 6 on the client numbers, a lot of success coming through in FIC and sort of financial markets, but the commodities business has been a lot flatter in FY23 to date. So just wondering if there are certain shorter term factors, I guess, that have been impacting some of that underlying client growth in the commodities business.
I think across the commodities base, we've seen a little bit of recycling of some of the client base, because for instance, when we were building out our business in Europe, we did for a period see exposures grow with the underlying price in underlying electricity and natural gas price, and at a certain point, we have no more appetite to deal with them as the exposure continues to grow. So we've got to wait for that exposure to come down before we're prepared to deal with them again. And you saw that in terms of the credit capital that we hold against that exposure. But what we managed to do was replace a lot of that income, particularly in Europe, with new clients that we were able to access through the establishment of Macquarie Bank Europe, which has been a really good opportunity for us to grow into that market. And what we've seen is that franchise has been able to grow new clients whilst we've waited for some of these other clients' exposures to reduce, and we expect that will come back in the coming year.
Thanks. And just a second question on FIC. With the push into sort of, I guess, the private equity base there and sort of the position in private debt as well, just wondering how much of your activity there is reliant on deal flow, particularly in the current backdrop, as opposed to sort of just rolling existing hedging with those clients?
This sounds like a great question for you, Glenn.
It's a combination of both, right? So there's constant hedging. Clients don't necessarily hedge out the full tenor, so you'll see hedging for periods of time. But to your question, capital markets, if it slows down completely, will that have an effect? Absolutely. On the other hand, are we seeing massive growth in the private credit space? Yes, and that is even continuing in this environment. So I think there's a lot of room for us to grow there.
And just a second question on that, the shape of the yield curve, how much does that determine activity as opposed to just, hedging out from a risk management point of view anyway?
Well, I mean, the biggest thing in terms of hedging for us, to be honest, another thing that's really helped us a lot is rates going up in the US has led to a lot of portfolio level hedging. So that's been dramatic. I don't think it's the shape of the yield curve so much, just the fact that a lot of companies weren't hedged. They came into this cycle and have been surprised by the hiking cycle. We're still seeing hedging going through. I mean, people are still getting caught off guard every time the Fed speaks. So we actually think there's more activity to come just in the last couple of months and the activity we're seeing there. So,
thanks.
Yep.
Andre, just at the front here. Thanks.
Good morning. Can I ask my first question just around international cross-border revenues? You've given us a nice chart there highlighting the EMEA versus America, Asia and Australia. But what % of your revenues are related to helping your clients with international cross-border trade? And how do you decide where to book those revenues?
Sorry, what was the second part of the question?
And where do you decide to book those cross-border trade revenues?
Yeah, I'll answer the second part first because that's actually a bit easier, and I'll try and answer the first part after that. So where we book the revenues depends on a couple of things, but it'll come down to factors such as where is the customer domiciled, or where is the contract originated. So if the contract's originated in a certain jurisdiction and that's where all of the work is actually being undertaken, that's where we'll ultimately do it. But more often than not, it's where the customer is domiciled, because the relationship manager is more likely to be closer to that individual. In terms of how much of our business is generated from cross-jurisdictional transactions, it's not really something that we spend, or I spend, a tremendous amount of time analysing. I know it's growing. If I just think about the amount of business that's been generated just from the growth in our LNG franchise over the last couple of years, that's been kind of really significant. But that P&L will drop into a number of different business lines depending again on where the client's domiciled. So we've got Asian P&L there, we've got European P&L, and we've also got American P&L. So as Tim pointed out, we're uniquely positioned to service that market given the global franchise that we have. And I'm not sure how many people who have the derivative or the financial engineering capability that we have also have that global coverage to be able to explain and understand gas movements and electricity movements in domestic markets, which are driving the LNG demand in the LNG markets.
Thank you. If I can ask a second question around energy transition, can you give us a feel for maybe what % of your revenues currently come from that, and maybe also what % of your current client base actually tapping into those energy transition services?
Yeah, it's a great question, because where does the transition start and where does it end in terms of what's the current contribution from an energy transition perspective from revenue. But perhaps answering the second part of the question, Janet, might be an opportunity for you to give your perspective on the types of conversations that you're having and the types of opportunities you're seeing and what's translating into actual outcomes.
Thanks. I think the question was types of clients and the client sectors that we're seeing and where those come up. It's every client and every client sector. When I stepped into this 2 years ago, it really felt like, as we were getting, moving along, it felt a little bit more like headwinds versus tailwinds in the first 6 months of this, even though we've been doing this for quite some time. But as the clients all, sort of really began to focus on what they were going to do and their business models and their strategies, you saw conversations in every sector. In some regions, we were ahead of the game as compared to others, but it's happening in every sector and with every client. And interestingly, depending upon the sector and the client, it could be so many different technologies, right? I mean, they could be looking at hydrogen or methanol or renewable diesel, if it's the refining or the oil and gas sector. It could be cleaning up their whole methane footprint, so we gave a couple examples of that. In all the other sectors, plastics and recycling, and it's really just across the board in everything that we're doing.
If I can ask a quick third question, just in terms of my understanding of the slides. On the storage capacity in US, there's 2 separate slides, and one suggests the total market is 69 BCM and Macquarie owns 49 BCM. So does that say Macquarie owns about 2/3 of the US storage capacity?
No, sorry, sadly. We don't have that level of scale. But perhaps a question for you to answer Tim.
Just takes a minute. No, it's the one with the
one says
supply demand.
48.9 BCF or something, which is our holding. Maybe get started.
Start answering, yeah.
Yeah, the 69 BCF of working capacity is the reduction in the overall North American. So it's kind of a different number than, the amount of storage in North America is in the TCF. So this is, the 69 was a reduction in the...
I think it was a reduction over the last 10 years.
Over the last 10 years,
So how much the system has lost in terms of storage, I think, Tim?
That's right.
Yeah.
And then the other number, there we go. So, so you can see the 69 is 2% decrease since 2013. And I think our other slide was,
I think
there's another slide.
Yeah, the other slide was our capacity, which is about 50 BCF.
Yeah, our capacity, and also we have, there are products that are lookalike storage products that they're called parking loans. So we also have quite a bit of that. I think something like 242 BCF of that as well. So kind of different numbers.
Yeah, exactly. Michael?
Nick, thanks very much for all the detail and the opportunity to hear about the business. Now, my question might actually reveal a bit of my personal health situation, but could we look at slide 9, please? And this is an excellent chart because slide 9 has all the different operating income. I don't quite understand. I think there are 9 categories in the legend, but there's only 8 shown. Am I missing something?
It will be one of the very different shades.
Right, okay.
Yeah, and yeah, it's going to be in the shading.
Right.
I doubt it. Yeah, that's what it's going to be. I don't know which one specifically it is, but I can go back and
screen resolution.
We can look at that later. We can look at that again later and get back to you on it though. But it'll be there.
If we can go to Andrew Triggs. Thanks.
Thanks. Sorry, just a quick question on the financing business. Have returns in that business improved? I presume from an ESG lens, it's probably an area that other banks might have pulled back from. Has there been any change in competitive nature of that market and change in competitive dynamic as well with more sort of private market players?
So our financing business covers a very wide range of activity. I presume you're referring to the commodity side, which also has a very wide ranging scope as well. I think in terms of some of the inventory-based financing products, and maybe Dan, you can comment on this. In some of the markets, we've probably seen the opportunity for spreads to widen a little bit. Dan, in others, not quite as much.
Yeah, I think that's right. We have seen a pullback in some of the, I guess, traditional markets like reserve-based lending and things like that. We have seen some banks pulling back. I'd say for our business and the inventory financing we're doing, it's slightly different, and we're not offering that necessarily that homogenous product that a lot of other banks are normally doing. So we sort of weren't competing in that space necessarily as much anyway. And in our space, what we are seeing is like in the inventory financing where we're owning for people, that some pullback of some of the, I guess I'd say some of the French banks that were very active has created an opportunity for us to actually access clients that we couldn't access in the past. Is the spread wider? I don't know what they were charging before. I suspect for us to make our hurdles, it probably is. But it's the appropriate margin for the risk that we're having in those transactions that we're able to capture now. And we're just seeing a wider range of clients coming to us with those needs as others have pulled back. And I think the product that we offer is really different as well. The way that we approach it and the way we have our operations and scheduling teams that are able to control and secure the inventory and are much more hands-on and involved with the inventory that we're financing, it's a really different product to what some of those banks used to traditionally offer, and hence why we charge more for it as well, because it is quite operationally intensive for us.
Thanks.
Any other questions? Shouldn't have asked. Brian?
Nick, there's a lot of stuff today about gas. What else? What are the other commodities that we should be thinking that basically you're long vol? What else should we be watching?
Well, by definition, power obviously is an extension of what's happening in the gas markets, and we're building out our business across all of the other commodities as well. We haven't talked a lot about the metals business, but we've got quite a significant franchise in the metals business. obviously the oil business and the agricultural business as well, are areas of opportunity for us. But by definition, the very way we've structured our business, we need volatility at some degree for our customers to be active, because our customers tend not to feel like they need to protect themselves if they're not worried about something happening. So generally, that's why we tend to think of our business as a long volatility business, because when something's actually happening in the underlying market, producers of commodities want to protect themselves against the variability of their income, and of course the consumers want to protect themselves against rising costs for their individual business or for the commodities that they consume. So it's really across all the businesses where we see the volatility will drive the outcomes.
And actually, Andy, I'll go to Andy first. Sorry, Kieran. You go, Andy.
Thanks, Nick. Just sort of following on is, obviously your business benefits from volatility. I mean, what's the biggest sort of risk for you then you see? Is it around, just for your business generally, worried about people? If you do get a recession, I mean, again, just how immune is your business? I mean, it sounds like clearly volatility is the big thing, but just what are you most worried about, I suppose?
I worry about everything, which is just the nature of this type of business. We're constantly thinking about what is the worst case outcome and what could impact our business in the short term and in the long term. So, look, we're very cognizant of the fact that this is a people-based business, as much as it is a business that is focused on our clients. But our clients have our relationships with the firm, but they have relationships with our individuals as well. So we're very focused on that. We're focused on whatever the financial risks that are within the portfolio and making sure that we're managing those, and we're mitigating those risks and understanding what those outcomes are. But ultimately, one of the things which we do come back to is volatility in the business, and volatility is driving the earnings at a certain level. But what we do have is diversity, and it's the diversity that gives us that confidence that I talked about earlier, that we have a strong franchise, because there are so many different business lines across asset finance, across financial markets, across the 11 different businesses within commodities, that gives us the confidence that whilst we might see volatility come off in one market, it's unlikely it's coming off in all markets. There's always something that's happening. There's always someone that needs to finance something. There's always someone that needs to grow something, or there's always someone who's concerned about a certain movement in a potential market. So yes, we worry about volatility, but the reason why we're okay with that is because of the diversity of the underlying business. And what's driving that diversity is the array of clients that we have, and the fact that we actually have products that they need, right? And so one of the things we always think about when we're entering into a new business is who's going to pay us to be there? Why are we there? And when we understand why someone's going to pay us to be there and why they're happy to pay us, then we know we're providing them a service that is of value to them, and then we know we have a business.
I'll take one more. Kieran?
Thanks, Kieran Jarden. Just a kind of related question in regards to that on the physical execution and logistics side. If you don't own and operate sort of some of the underlying storage and transport assets, how confident are you in securing sort of those long-term services? What is sort of the average duration of the contracts you've got there, and particularly given the increase in profitability you're seeing at the moment? Just wondering around sort of the pricing and contractual pressures coming through.
It does come down to the way the market is structured. I'm going to hand over to Cindy here in a minute to answer that question, because she's better placed to answer this question than me. But in terms of the unique way that some of these contracts are structured, there's a concept of a right of last refusal in some of the markets that we operate that relates to transport of things like gas. That means the incumbent has the opportunity to match any bid in the market to roll things forward. So we feel, given the long tenure that we've had in the business, the scale of the network that we've built up, we've got a good mix of balance across those. But I think Cindy can probably give a bit more colour in terms of the length of the portfolio and various other things.
So our sweet spots are typically within 3 years type of tenure. But let me touch on the gas side first. Nick referred to about the right of refusal means that if you own the capacity for longer than a year, you have the right to renew that capacity. And that capacity kind of expertise that we've been built is well over a decade. I mean, Tim has presented that we have senior people that's been with us for, on average, about 19 years. But in reality is that the expertise in a lot of these people are well over 2 decades. And AKA, like Tim's been in the industry for over 30 years. So that's kind of a color on the gas side. On the power side, Tim did a great job kind of presenting on the transmission. Not only are we involved in a year type of transmission, but the knowledge base really gives us an edge on when the needs are there, we can be nimble, referring back to the Storm Uri, how our Southeast power team that came through from Cargill team was able to acquire capacity that's out there that maybe that we identify as needs are variable as weather has presented. So those are kind of some of the examples that we participate on both gas and power side.
Great. I think we'll leave it there. So thanks for all your questions. Thanks for your interest. I'll ask Alex to come up and close the tour. Thanks very much.
Thanks, Nick. Well, thanks, everyone. I just wanted to start by saying thanks to Nick and his team from CGM. I thought it was I'm sure I reflect the comments or the feeling of everyone in the room. It was great to see the team who actually look after this business, deal with our clients, and have built this business over a long period of time, stand in front of all of us today and actually tell the story. So I want to thank the CGM team. It's obviously great to be here in Houston. I think I might stand between you and a tour of the trading floor and a Houston barbecue lunch. I think that Tim's organised for us. So I'm going to be relatively brief, but I do want to touch on a few things. Firstly, I wanted to say thank you to all of you, to all of you for spending a good amount of time with us. 3 days is a lot of time to ask you to spend with us. I hope you found it incredibly helpful. One of the things that we wanted to do over the course of the last couple of days was actually give you access to the people who really run the business here in the Americas. I think it obviously, hopefully, makes it real for you in terms of what we're actually doing in these markets. So thank you very much for spending time with us. Thanks for coming to the Americas with us. As I said the other night at the dinner, it's the first time that we've done our operational briefing offshore. I thought it was I really enjoyed the event the last couple of days, and I thought it was a really valuable exercise. I hope you did as well. But we know your time is precious. There's lots of other things that you need to do on a daily basis. So thank you very much. The other thing I wanted to do was just thank our teams across CGM here today, of course across Macquarie Capital in New York yesterday, and the Macquarie Asset Management team. And of course, our corporate affairs team, I can see Paul up the back, and our investor relations team. I know a huge amount of work goes into these presentations. There's a lot of content that comes together. So thank you for all the efforts that you've all put in. And thank you also for the time that you've spent with the really important stakeholders in this group, the shareholders, obviously the analysts that cover us, and our bank relationships, which are really important to the group. So I really appreciate all the time that people have put in. As I said, I don't want to spend too much time because I'm between the trading floor tour and the barbecue, but I wanted to just highlight, I guess, reinforce a couple of things that I think hopefully you've seen consistently talked about over the course of the last couple of days, and the things that really give us confidence in terms of the future of our business here in the Americas, based on the big platform, or the platform that the teams have built so far. Now, the first thing, of course, is that, and you heard a lot of this throughout the 3 days, client-driven business, a diversified business, really, really important. And it's consistent through whether it's the asset management business, whether it's the Macquarie Capital business, or the CGM business, really, really important. The other thing that I think is interesting about all three of the presentations that I hope came out in the discussions There are, I guess, maybe let's call it 4 pillars that I think are consistent throughout each of the presentations. And that is that the businesses that we've built here in the Americas, first thing is they're built on deep, specialised, differentiated expertise. Macquarie Capital uses the term, we're not trying to be all things to all people, but there's a real consistency in that. We're trying to bring a differentiated capability to this market based on deep insight and deep expertise. The second thing that I think is resonant in all of the conversations is just the experience of our team. And we saw it here today. We obviously had various numbers quoted in terms of the tenure of the EDs, but the experience across the board of the team, I think, is something that's really fundamental to the way we built the business here in the Americas. Indeed, it's fundamental around the world, but certainly here in the Americas. And not just the experience, but the differentiated experience. It's not just all investment bankers, it's not just all trading people, but as Nick talked about today, it's schedulers, it's logistics people, it's meteorologists. As John Pickhaver talked about yesterday, it's engineers, it's people who've actually built things, people who turn a widget. So we've tried to bring together a team of people that are very experienced, that are committed to the sort of organisation that we're trying to build, committed to the clients that they're trying to serve, that come from very different backgrounds. And that's really consistent, I think, across all 3 of the presentations. The third thing is it's based on patient-adjacent growth. Right? It's based on patient-adjacent growth, really, really important. We're not trying to boil the ocean. We're trying to find an area where we've got something to add to the client proposition. We're trying to deliver solutions to clients. And then over a long period of time, we're trying to build out that footprint. So as we sit here 30 years later in the Americas, 48% of FY22's income came from Americas, 38% in the first half. That's come from years and years of patient-adjacent growth. So those 3 things are very consistent. I think the other thing that's really consistent and super important for us is our confidence and the heritage and the longevity of the approach to managing risk across the organisation. Right? It's all about risk being owned by people in the business who are close to the situation, really understanding they own that risk. Secondly, it's about understanding worst case outcomes and actually staring into those worst case outcomes. Not avoiding them, not trying to paper over them, but actually staring into what are those worst case outcomes and then being able to absorb those worst case outcomes in the context of the earnings of the business that wants to take that risk. Really, really important. And the third thing, of course, is that independent sign-off. That independent sign-off from the RMG group that challenges us, that actually challenges, is this the worst case scenario? Do we understand this proposition? Are we really meeting a need? Do we understand what could go wrong? So really, really important. So those 4 things, I think, are consistent across all of the groups, and they give us real confidence, I think, in terms of what we built here and what it looks like into the future. Second thing really is this idea that what the teams are trying to do, and you've heard a lot about this over the last few days, what the teams are trying to do is really deliver solutions to clients in areas of unmet need. Really, really important. We don't want to just play where everyone else is playing, because if you play where everyone else is playing in a competitive environment, reality is your margins get squeezed, right? And Nick talked about the situation today with the mobile leasing business. We came out of that business because the reality is the margin there wasn't sufficient for us to want to continue to invest capital in that proposition. The team adapted, learned, moved on to the next, and out came the leasing transaction that Nick talked about. But the idea is the teams are trying to focus on those areas of unmet need. And the context of Americas, of course, the other thing that we find obviously is the policy framework that you've heard a lot about over the last couple of days. In areas that we've got real capability, infrastructure, we're the largest infrastructure manager in the world. Renewable energy transition, we're one of the largest renewable energy developers in the world. Here in Houston, just talking about the dislocation in the energy markets, energy transition is creating opportunity, big opportunity for the team here to actually service the client base and help them manage that. Yesterday in New York, we heard from the Macquarie Capital team, from Bill Ekman, talking about the opportunity in private credit. There's a vast opportunity up there. There's a growing opportunity up there to deliver tailored solutions to our clients. And so this idea of a big market with a policy framework, things like the IRA, I won't be the 15th person to talk about the IRA up here, but things like the IRA make a big difference. But so does the Infrastructure and Jobs Act. As Michael Silverton talked about yesterday, $1 trillion of investment going into infrastructure in this country, and infrastructure and jobs creation, 9 million jobs. So huge amounts of room for us to grow here in the US. The asset management business, half of the world's assets under management are actually based here in the US, and that pool of investing capital or assets is looking for the things that we think we can bring. So we think we're differentiated, we're diversified, and we're sitting in a market where we've been for a long period of time, and there's a lot of opportunity to go. The third thing I think you heard from all of the groups is just this clear vision about where we're headed. I think all three groups have got a real sense of what are the next steps to take. It'll be based on the same framework that we've worked on for the last 30 years, I'm sure. Growing our client franchise, patiently growing into the next area, continuing to deliver solutions, bringing our balance sheet where it makes sense, investing our balance sheet in equity and principal opportunities, growing out the secondaries franchise. It'll be all those things you heard about over the last few days, and trying to grow into that large market that we think here exists in the Americas. So all that together, of course, gives us confidence in the medium-term outlook for this business. And I hope after hearing the presentations over the last couple of days, you also have confidence in what we're trying to build here. There will be periodicity, and we've talked about it before. There will be periods of time where the volatility is not where we like it. There'll be periods of time when activity reduces, and we're seeing some of that now in the M&A markets. But the reality is that our franchise here has been built over a long time and is positioned in areas where there's growing demand for what it is that we're offering, and that will continue to be responsive and adaptive to market conditions changing. And that gives us confidence in the medium-term outlook for activities here in America. And of course, America as a part of our entire business, or the US, Americas as a part of our entire business, is a large and growing component. So hopefully you took all those messages away. I hope that in the closing there shouldn't be anything you haven't heard before, and I'm sure there wasn't. Again, thank you very much for giving us some time. I wanted to finish really just talking about the Macquarie Group Foundation, just to change gears from energy transition for a second. But we are talking about transition in another way. The Macquarie Group Foundation, and Sean Lytle on the opening morning talked about this, the foundation for Macquarie. We've had a foundation since 1985, so it's a long heritage part of our organisation, and really, really important for our staff and for the communities in which our businesses around the world are actually transacting. So the foundation plays a really important role in aligning our philanthropic activities with what our staff and our teams think are really important issues in the local communities in which they operate. And really, really important. If you go back to David Clark in the 1980s, talking about the importance and the responsibility that business has to contribute to the development of the communities in which they operate. So that we talk a lot about that today. David and our forefathers, if you like, were talking about that many years ago. So foundation really important. Here in the US, what are we really focused on? We're really focused on economic mobility, and it's economic mobility that's really driven on the back of employment pathways and education pathways, and you're going to see a video about this just in a moment. In addition to being the CFO, I have the pleasure of being, or the honour of being, the chair of the Macquarie Foundation. I love the role. It's fantastic to see our people, all of our people around the world, actually using the acumen that they bring in a business sense to try and solve really important problems or opportunities they see in local communities in which they operate. So thank you for all the questions. I look forward to the trading floor tour, look forward to the barbecue, and again, really appreciate your time. So with that, we might go to the video. Thanks.
Social Finance is an impact finance nonprofit, and we work in the United States. Our mission is pretty unusual because we work at the intersection of finance, policy, and philanthropy. And we often think about blending capital in new ways to drive measurable outcomes for our communities. Being one of the 50th anniversary awardees back in 2019 has just been transformative for us. Macquarie came into social finance at a time when we were just pioneering and building and testing a career impact bond model. And in the last 3 years, this funding has allowed us to pioneer several really exciting strategies. So how do you think about all the different alternative pathways to prosperity, to economic opportunities, and how do you make sure that more low-income Americans can take advantage of these opportunities, especially jobs of the future and sectors of the future like clean energy and IT and healthcare jobs. With the Macquarie funding, we've been able to test many different models under this construct. And one particular example is a program that we developed with the American Diesel Training Center, whereby after 5 weeks of immersive training, a unskilled worker would come out on the other end with a diesel technician training certificate. Stephanie's story is truly an inspiration. She went from a series of low-wage jobs, jumping from one job to another, and really was looking for a better life for herself and for her son. After several weeks of being in this program at American Diesel, she was able to land a great job with good pay and benefits at an agriculture company, and within a mere few months have had already 2 pay raises. Stories like Stephanie's really give me hope that through innovative workforce finance models, we can really replicate these success stories at scale. Macquarie and our other funders gave us this really important R&D capital, if you will, to test a brand new strategy to think about workforce finance. Without this funding, there's no way we would have taken the kind of risks to achieve outsized impact and this degree of innovation. But it's not just the funding alone. The thought partnership from both colleagues at the Macquarie Foundation as well as from Macquarie Group has just been invaluable. The funding has not only been transformational for social finance, but really for the tens and thousands of individuals that our strategies have been able to support them into better lives and greater prosperity.
My name is Stephanie Reyes. I live in Bakersfield, California with my 5-year-old son. Since school, I've had so many jobs: fast food, housekeeping, retail, and working as a teacher's aide. I wanted a career that would allow me to grow, but I struggled to find an affordable training. I needed something that would provide for us long term. I found American Diesel Training Center on YouTube. They had a 5-week technician program, which was free up front. They'd even help me with other expenses, plus threw in a toolbox. It was like too good to be true. With the support of my family, I was able to fly to Ohio for the course. The 5 weeks were intense, but I worked hard and the instructors encouraged me. They held my hand, offered the financing, helped me write my resume, and barely 2 weeks in, I had a great job lined up. It seems there's so much work, but many people don't have the skills. Social Finance designed the financing so people like American Diesel can train more people like me. My qualifications earned me a job at Sunbury Machinery. As a result of training, I now have a steady job which will lead to bigger things. I work 40 hours a week, there's overtime if I want, and in my first year, I have already received 2 pay raises. It's a job I never expected to be qualified to get, and never expected to love so much. I'm so proud because it's not just a job, but a career that I can use to look after myself and my son. You know that when he grows up, he wants to be a fireman, and when he is, he wants me to fix the trucks.